What are the risks as we see interest rates rise, because it looks like the Fed's going to keep raising, at least for the time being, that there could be some cracks develop that we don't even understand fully on the private credit side?
Well, once again, it's an informational issue. Who knows what is there? And I think one of the problems going all the way back to 2007 and 08, that nobody really knew what the mortgage banks, the non-regulated segment of the mortgage system, held and what the credit quality was. So as rates rise, and if they continue at a high level, there are the two impacts potentially on private credit. One is a higher level of defaults, and the second is the cost of funding goes up. So I return to the idea of information and disclosure being critical, at least to the government.
Finally, Raj, 2022 was a rough year, I think it's fair to say, for cryptocurrency. That was even before we had the FTX situation. Are we going to finally get that regulation of crypto in 2023?
You know, I would certainly hope so. Admittedly, it's a fiendishly difficult area to regulate, but I've got to be frank and say that I regard the failure of Congress and the regulators to regulate crypto is just an abdication of responsibility. You know, Humpty Dumpty is sitting on the wall, and we shouldn't wait for Humpty Dumpty to fall with the consequences which the nursery rhyme explains.
Yeah, all the king's horses, even you maybe couldn't put it back together again. But finally, you mentioned Congress and the regulators. Do we need Congress to act? Can the regulators do it on their own?
I actually think it would be preferable if Congress would act, because crypto does not readily fit into any of the existing regulatory schemes. And a more comprehensive approach would make more sense. Right. But I think the regulators can't just keep waiting for Congress. Right. And if Congress fails to act, the regulators must step in.
Raj, thank you so very much for being with us. This is Raj Cohen of Sullivan Cromwell. Still ahead, bringing some rigor to the wild, wild west of ESG investing. We'll hear from former Bank of America executives Ann Finucane and Tom Montag about their new venture. That's coming up next on Balance of Power on Bloomberg Television and on radio.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
Unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
The pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
the red wave that never was.
Protesting his zero COVID policy. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. ESG, environmental, social, and governance investing, got a lot of attention in 2022. And let's be honest, not all of it was good, as some states took action against funds taking ESG into account in their investments, even as parts of the federal government tried to encourage it. But whatever the merits of the argument, it helps if there is a standardized way of measuring it, particularly when it comes to carbon emissions. This year, TPG announced it would back a new venture to bring a transparent and reliable measure to carbon emissions, led by the former COO and former vice chair of Bank of America. We sat down with Anne Finucane and Tom Montag to understand their firm and their goals.
As more and more companies are looking to become carbon neutral, which is the first step in becoming net zero, they do an audit, they review what they can do, and there's a delta between everything they could do and what is carbon neutrality. And the sort of basic practice has been to fill in that delta for the short term with carbon credits. But they are not plentiful. They have had some controversy around them because looking back, they've not been well vetted, and they may not be as good as they could be. So we saw an opportunity to improve the whole market. One, to fulfill what clients need, to put money into the developing world. In other words, cash into protecting forests for removal as well. So this is carbon reduction, carbon renewal, carbon removal. And in order to do that, we needed to set up a system that would be much more, I think, acceptable to not only companies, but to the NGO world. So what I'm talking about is that these credits would be vetted through proprietary quality guardrails. They would have third-party ratings. It would be a methodology that's transparent. And so people could feel comfortable with this new product.
So Tom, you're going to be the CEO of this. You've spent a career really in and around the markets, whether at Goldman Sachs or at Bank of America. Are you making a market in these carbon credits? Is that the way it's going? You're putting together people who put them together with the people who need them?
We're making a market in the sense, David, that we're actually, we're offering a product that they can buy. It's not yet a tradable product. At some point, it may be, but at this point, we, as Ann said, we've established Rubicon Carbon kind of solutions company, and the first product we have is what we call Rubicon Carbon Tons. And that is what we are offering to enterprises around the country.
Well, tell us what's in that Rubicon Carbon Ton when it's available. What is in there?
So what we've done is that, our three words, if you go to our website, rubiconcarbon.com, are scale, confidence, and innovation. And so we basically have already purchased a number of carbon credits, and we sell them to you in basically a portfolio. And there's two different portfolios. There'll be a third, and there'll probably be more over time. We have a nature-based portfolio and an emissions-based portfolio, and we'll have it a removables. And each one of those, underlying those Rubicon Carbon Tons in nature, has numerous projects that we've already purchased, and we curate constantly. So we've hired Dr. Jen Jenkins as our Chief Sustainability Officer, and not only do we look at them when they come in, but we're always looking at and curating what's in there. So you would buy the right to retire carbon credits in the portfolio of your choice at any time that you wish.
So, Ann, do you essentially certify that, in fact, these credits exist and that they're legitimate? You and I have talked in the past about things like greenwashing. Does this address that problem to some extent? And do you need the government to certify it?
Well, let's just go back here for a minute. I think the problem with carbon credits is more retrospective than it is current. Retrospectively, it was a nascent industry early on, small players, and standards were not set. So, yeah, in some places they were questionable. But today we have much more transparency. We're working with NGOs. We not only will work with those that certify and verify today, we're essentially taking another step, and we are doing our own project level diligence. So this is sort of an insurance on top of an insurance. And actually, beyond that, we're going to be doing some work in terms of insurance itself and risk management. So if you were a client and you came to us, I think that you would have much more confidence. First of all, the projects themselves are forward-looking, not retrospective. We recognize what the issues were in the years gone by. We're not buying renewable projects in OECD countries, meaning we're not trying to make renewables in America, which are actually cheaper and easy to get to, part of the credit basket. What we are doing is looking to the developing world to help, and I think everybody needs removables. So we'll be transparent, we'll be easy to use. The credits are verified, certified, and we're taking a second look at them through Jen Jenkins' group. I think that this is a sort of end-to-end process. We're working with developers, we're working with brokers, and we may actually source credits ourselves in the years to come.
How big is the breadbox?
Well, let's just talk about how big is the need. By any dimension, we are looking at a need, a delta of $3.5 to $4 trillion a year needed to create a net zero world by 2050. And the scientists, the NGOs, governments would like to see us get halfway there by 2030, so, or at least 45%. There just simply isn't enough money to do that in the current equation. Governments can't do it, philanthropy can't do it, and businesses are really not set up to do it. You will see more of that in the years to come, but we're talking about $4 trillion a year that is needed to fill this delta. Meanwhile, through some commitments that have been made, you know, about 90% of the world is committed to some form of net zero. But the Glasgow Financial Alliance for Net Zero, otherwise known as GFANZ, is a collection of 500 financial firms who have committed to be net zero. For financial firms to be net zero, all of their clients have to be net zero. That means not just big corporates, but middle market companies, small businesses, and ultimately consumers. So imagine that kind of task ahead of us to help clients and customers become first carbon neutral, ultimately net zero.
Tom, that's exactly what I wanted to ask you about, because you and Ann worked on green financing when you were at Bank of America. If a Rubicon Carbon had existed when you were doing that, how would it have made your life different, and how will it really interact in general with banks? I saw, by the way, Bank of America, I think, is an investor.
That's right. They are an investor. I think what Ann was just saying is that we think this product allows people to get at-scale financing more frequently. And so we're hoping through Rubicon Carbon Capital that we'll be able to bring as much money as is necessary to help solve the problem. And David, the other thing is when you look at Rubicon Carbon Tons, it reminded me of the more liquid and the more people are able to invest in a simple manner, the more money comes into a product. And I always looked at it as I looked at the derivative market back then. The derivative, when I was in the beginning of the derivative market, it was a very bilateral, not tradable market. And its growth largely came from the fact that people got together and had standard agreements and masters and did all the kind of things to make the market more liquid, which brought more money into that market. We hope by doing what we're doing now, we bring more money in to help solve some of the problems.
And how do you make money? How does Rubicon Carbon make money in success? Let's assume this all works perfectly. Where do you get your money from?
Well, there's a margin, if you will, on what we package for our clients. So that's how you make the money. And it is certainly less expensive for them than keeping an entire staff on call within their own operations. And it's completely unrealistic if you go down the food chain to middle, small market, and small businesses and consumers. So we'll make a fee for our services. I think that relative to what it would cost somebody to set something up, it will be de minimis. And this is really out of work that I want to sort of make a point about two different worlds that are coming together unexpectedly. In the NGO space, out of COP27, it was clear to the NGO community that we need to be able to find sources of funding that doesn't currently exist. And if the carbon credit market can be more transparent, the products clearer, more forward-thinking, the people involved with, on the one hand, good financial background, but also understanding what the issues that the NGO world has, then that's for them a very good thing, and I think we will supply that. On the other side, we have Jim Coulter, Hank Paulson, Mark Miczinski, and others who pulled together Rise Climate and raised $7.5 billion for new investment in new technologies for this very same issue. So you have an investing community that's interested, you have an NGO community that's interested, and you have a client base that needs the help.
Tom, you said earlier this is not a true exchange where you're not really trading in these carbon credits. Do you envision a world where you do create an exchange? How far are we away from that world?
That's a great question, David. I do believe at some point, given the volume that has to be done, that there will be an exchange of some sort where we can buy and sell a standardized product. Again, remember, these are retired, kind of like a maturity, I guess, of a swap or a bond. And so there will be trading, I think, at some point. I don't think we're really that close to that, but can I see that in the next 3 to 5 years? Yeah, I can see that happening.
I think we're all hoping that we can establish a price for carbon, but it's in these kinds of activities that we'll be able to do it, because it needs to scale and it needs to be something that is more understandable to the financial markets.
Tom, you've dealt with exchanges a lot as a trader and otherwise. Are there things you've learned that you would apply here? You could do it better?
I think, certainly my experiences are going to help us establish something that people will want to work on and work with us on. And so hopefully together as an industry, we can get something together that people want to standardize and then want to trade in a liquid fashion. And that liquidity always brings in more money, which is the scale part of this.
That was my interview with Ann Finucane and Tom Montag from Wall Street Week earlier this month. Now I want to keep you up to date with news from all around the world. And for that, we turn to Lisa Mateo here with the first word.
Thank you, David. Democrats' plans to release former President Donald Trump's tax returns may be the start of a tit-for-tat battle. According to a Republican aide, this could start a trend of using IRS documents to target political foes. Republicans who will take charge of the House Ways and Means Committee may retaliate by publishing the tax records of Democrats. The anonymous aide argued that Democrats may end up regretting the move. Another sign of how the U.S. labor market is staying resilient despite the Fed's aggressive efforts to cool demand. Applications for unemployment benefits rose last week but remain near historic lows. Initial jobless claims increased by 9,000 to 225,000. That was in line with median forecast. Russia is ruling out peace talks with Ukraine and says it won't give up despite setbacks on the battlefield. Foreign Minister Sergei Lavrov also told a state-run news service the Kremlin will not discuss Ukraine's demands that it withdraw from occupied lands and pay reparations. The war is now in its 11th month. And in Italy, authorities didn't find any new COVID variants among recent arrivals from China who tested positive for the virus. That's a relief for officials worried about fresh health threats. Both Italy and the U.S. have joined an increasing number of nations demanding COVID tests for travelers from China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, education is right at the center of our society and our economy. If we can't educate the next generation, we certainly will not have workers who can be productive. At the same time, education was hit as hard or maybe harder than just about any other part of our country and our society by the pandemic and the shutdown that followed from that pandemic. And some of the students who can afford it least got hurt the most. We're going to talk with former Education Secretary Arne Duncan about where we are, just how much we lost in the education of our students during that period of time, and whether we can get it back on track. If so, what it will be required to get that done. Arne Duncan, who knows education like few others, having run the Chicago school system. That's coming up next on Balance of Power on Bloomberg Television and on radio.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. There are some test scores coming on now that I find, frankly, alarming. The extent to which many of our students, our public school students, really lost traction during the pandemic as they were not in school. The question is, how bad is it? What can we do about it? For some answers, we turn now to Arne Duncan. He's managing partner of the Emerson Collective. Mr. Duncan served as President Obama's Secretary of Education, and before that, as head of the Chicago Public Schools. Arne, great to have you with us. Happy holidays to you. But this is a very happy subject. How bad is it out there?
It's pretty devastating, David. I just appreciate you raising awareness of this issue. So if you look at those national test scores, whether it's a math or reading, 4th grade, 8th grade, the story is basically very similar. 2/3 to 3/4 of our students are not at grade level, are not where they need to be. And as we know, the children who are the most vulnerable always get hit the hardest when you have catastrophic events like COVID. So I saw one study that showed that children in the bottom 10% fell behind 4 times as much as students in the top 10%. And so nothing easy here, David, but I just think we need an 8-month sprint, high dosage tutoring. That's the best thing, whether it's physically, virtually, hybrid, both, whatever it might be, for every single child who's behind, trying to catch them up before we go back to school in fall of 2023. We can't afford to start another school year with kids being half a year, 18 months, 2 years behind. Basically, at some point, we lose them altogether, and I don't want to get anywhere close to falling off that precipice.
And Arnie, as you have said repeatedly, there's a moral imperative here as a society. There's also an economic aspect to it. I mean, the Wall Street Journal has a piece out that's estimating something like it's averaging $70,000 per student will be lost over their lifetime income if we can't make this up as a practical matter. So we also need it for our economy if we're going to have a vibrant, growing economy.
That's exactly right. And again, if you want strong families, if you want strong communities, if you want a strong country, if you want to keep high-wage, high-skilled jobs in America, we all have to come together. I say all the time, David, education is the ultimate bipartisan issue. There's nothing left or right or liberal or conservative, Republican, Democrat about having more kids graduate from high school, more young people going to college. If you drop out of high school today, David, you're basically condemned to poverty and social failure. There are no good jobs out there. And if students fall further and further behind, they get discouraged and they will leave school. And so that's why it's an absolute crisis. I don't use that word easily or lightly. We are at a crisis educationally. We have to have a crisis response. We don't need, people get mad at me for saying this. We don't need another summer break here. We lost 2 years of schooling. We need longer days, weekends, holidays. Let's work through the summer. Let's do everything we can to close that gap so that students come back, children, our kids come back to us this fall on track and ready to be successful.
So Arnie, unpack that sprint you referred to just a little bit. You suggested it right there, but exactly, if you were czar, if you got to decide for everybody, what would that sprint look like?
Yeah, well, this is really a child by child, class by class, grade by grade, school by school endeavor. This is not some national thing, but schools have received unprecedented resources from the federal government. Some money is not the issue, for once in public education. But you have to identify for those students, whether they're a year behind in math and 6 months behind in reading, whatever it might be, what the challenges are. And then lots of things we need to study in education. One thing we don't need to study is how to help close those gaps. And it's high dosage tutoring. And that can be physically in person, that can be virtually, Zooming like we're doing now. It can be a hybrid, it can be both, whatever it might be. But it's more time with children, either individually in very small groups of 2 or 3, that if you do that consistently, 3, 4, 5 times a week, those students absolutely can and will and do catch up. So we know the answer here. This is not trying to find a cure for cancer or put a man on Mars. We know what to do, but this has to be very granular, very specific, child by child. Get them the dosage of tutoring that they need and the subjects they need. And let's do it with real intensity again now through August, September, when we return to school in the fall.
So, Arnie, as you know, I've been involved in a charity up in Yonkers for about 15 years now, and we have graduation coaches, we call them, adults who volunteer for 4 years from 9th through 12th grade to work with kids individually, and then we have an online system and a center they can come to. And I'll tell you, coming off of the pandemic, our numbers, and we monitor all of it all the time, indicate they did not lose very much at all. If that's the answer, why aren't more people doing it?
Well, first of all, I just want to say thank you. That's just extraordinarily powerful. I'm thrilled to hear it, but I'm not surprised because we're doing exactly what we know works. What we haven't seen, David, is a sense of urgency, and that's sort of what I'm struggling with and why I'm sort of trying to push so hard right now. I think there was some just, let's get back to school. Let's just open the doors. Let's just sort of keep rolling and, put the wheels back on the bus. And I understand that. But we can't go back to quote unquote normal because normal wasn't good enough for far too many of our students. We have to deal with the crisis. We have to deal with the emergency. We have to be honest with ourselves of how many students, this is David, tens of millions of students who are way farther behind than they would like to be or we want them and need them to be. We have to deal with that honestly, meet students where they are and give them a path to get to where they need to go.
Arnie, you made a really powerful point. It's not just a federal program that's one size fits all. You have to do this from the bottom up. That's certainly what I've seen. Yeah, because each school system differs. Each community differs. You got to deal with it. But how do we bring accountability to it? Because I'm not sure that writing checks takes care of it either, because you're not sure how that money's getting spent.
No, it doesn't. And this is where it's a great question, David. So what we have is we have the national data from the NAEP exam that says at a very high level, again, that 2/3 to 3/4 of our students are behind. That does not get to the individual student level. And so we need to have that honest assessment of students in reading, in math, 3rd, 4th, 5th, 6th, 7th, 8th grade, all of those things. We need to know where they are, have an honest conversation with them, their teachers, and very importantly, their parents to say, here's where your son or daughter is today, and here's where we want them to get to be. And those might be difficult conversations. They might be tough or uncomfortable conversations. But guess what, David? They're the truth. You're a parent. I'm a parent. As a parent, I think we all want to know the truth of where our students are. And then how do we all work together on their behalf? And absent those honest conversations, absent that assessment today, as we go into the new calendar year, 2023, go into January, where is my student today? And then where are they going to be in March, and then in June, and then in September? And those are the benchmarks that we have to be very, very honest with everybody and have everyone working on behalf. Everyone's on the same team working on behalf of our children. But absent that data, absent those assessments, absent those honest conversations, we're just talking at the macro level, David, and we are totally missing the boat here.
So, Arnie, talk about another aspect of this that I know you know terribly well. You and I have talked about your experience in Chicago, for example. You cannot divorce the education of a child from where that child lives, the circumstances around it, whether it's their home situation, which may be more disruptive than we would like it to be, or some of the community situations, such as violence in the schools. I mean, how many of us now know about kids who are getting trained in lockdown procedures, and what happens if there's an active shooter? What is that doing to the education of America's children?
Well, it's just absolutely traumatizing. And I'll just say a couple things. I appreciate you raising this, David. And again, unfortunately, gun violence has found school children in every part of America. Nothing is exempt. Nothing is immune to it. I say this with great pain, but I honestly believe in our country, we value our guns more than we value our children. And our children are growing up with a level of fear and trauma that's just extraordinary. And does that affect their learning? Does that affect their mental health? Does that affect their ability to envision a positive future for themselves and have hope? Of course it does. Of course it does. It doesn't have to be this way. And when we do these drills in schools, David, I just think it's so frankly just dishonest, disingenuous. People talk about quote unquote, this is the NRA talking point, let's quote unquote harden schools. Well, David, you can't harden arrival. You can't harden dismissal. You can't harden recess. You can't harden lunch. You can't harden extracurriculars and sporting activities after school. And so it's just very, very dishonest. We cannot divorce our schools from our communities. Our schools are part and parcel of our communities. Until our communities are safe, our schools will never be safe. And that's just the honest, cold truth.
So finally, Arnie, a lot of people, you lead, I'll put you at the leading of the pack, actually, understand the problem. They know what the problem is. As you said, it's a question of urgency, a sense of urgency we lack. You've done it in Chicago. You've done it at the national level. President Obama gave you a lot of money for incentives. Now you're doing it at Emerson Collective. Give us a sense of what we can do to get that sense of urgency. Where does that come from?
Well, let's take both sides. Let's do the education part first. Again, those are very honest conversations, right. Child by child, family by family, across the country, so that everyone knows exactly what's going on. So that's just, again, this is not high tech. This is high touch. This is relationship building between principals and teachers and children and their parents. On the gun side, this is not this wouldn't solve everything, but just putting back in place the ban on assault weapons that President Biden's been working on. That was in place a while back. That led to a massive reduction. Unfortunately, so many mass shootings in our country, including in schools, but not limited to schools. It's churches, it's nightclubs, it's ballparks, it's everywhere, bowling alleys. If we just put that back in place, we would save a heck of a lot of lives. And it's unfathomable to me that we don't have the courage to get that done.
Arnie, thank you so very much. Says Arnie Duncan, Emerson Collective Managing Partner. Check out the Balance of Power newsletter on the and online coming up. Stay tuned for Bloomberg Markets. And this is, after all, Bloomberg.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No. Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Yes, Virginia, there is a Santa Claus after all. A correction for Carol Master, Santa Claus does exist. 2 straight days of losses now. Well, that's all been recouped here with a 1.8, 1.9% rally on the S&P 500. Dip buyers coming back in, flipping what had been an incredibly down day yesterday with all 11 S&P sectors in the red. Right now, guys, all 11 S&P sectors solidly in the green.
Is it a Santa rally or a Santa sigh? Kind of like, we just got to do something. Give the bulls a little bit of something as we wrap up the year.
Yeah, he got like kind of caught up in that bomb cyclone or whatever.
Oh, my goodness.
Hey, the Santa Claus rally, we still got halfway to go. It also includes tomorrow and then, of course, first couple trading days of January. So,
okay. Well, thanks,
there's still a ways to go.
Yeah, great way to start off the show here, Tim. In all seriousness, though, I was taking a look. We had this conversation yesterday, I think, about Tesla, the idea of dip buying. A lot of folks looking at these valuations and saying that, no matter what you think about the recession and the basic fundamentals, there has been an oversold nature to some of the sell-off that we've seen over the last few weeks. And today, when you look at some of the names that are rallying hard, that seems to be the case.
It does feel like the narrative around Tesla all of a sudden, and that is certainly one of my gainers today, if we can bring it up for everybody, because we have seen this one on a tear over the last couple of days. It's added about 10, 11% between yesterday and today, top in the S&P 500, top in the NASDAQ 100. You got Morgan Stanley. All of a sudden, the analysts are kind of falling in love again, I guess. They are saying that derating in the EV company stock has created an opportunity. Analyst Adam Jonas lowering his price target to 250 from 330 while sticking to an overweight rating. We know Kathy Wood checked the Bloomberg over the last week or so. She has been buying big on those dips. We know she loves this name. Stock's still down about 65% so far this year, but guys, up 6% in this session alone. Let's go to Southwest Airlines. These are names that we've been talking about all week. Southwest, we know the story. We'll get an update a little bit later on, but because of the weather, the shutdowns, so many passengers stranded, well, it is rallying after a 2-day, nearly 11% decline. It is up about almost 4% today. The company is aiming for relatively normal flying operations tomorrow. We shall see, fingers crossed, for everybody trying to maybe get somewhere for New Year's. 2 more names. Netflix. This is one that's been beaten down big time this past year. It's down about 60% from its all-time high in late 2021. Top in the S&P 500, top in the NASDAQ 100. A former bear becoming a bull. We're talking about Ken Leon over at CFRA. He upgraded it, raised it to a buy from sell. He talked about many things, but also Netflix's best-in-class platform. And one more for you. Got to talk about the NASDAQ Golden Dragon. Netflix up 5%. No, it's an index, but it's up 2.5%, and it has been on quite a run, up around 50% since October 24th. The only reason I think it's going to cover a lot of things we talk about today, China, and what it means for 2023.
What do you got, Tim?
I got some decliners. They're actually pretty difficult to find. There's only 12 in the S&P 500. One of those is Campbell's Soup, down 0.7%. We're seeing those traditional areas of safety underperform today. Actually, Campbell's hit a 52-week high yesterday. Cardinal Health also down 0.5%. Cardinal Health is actually up more than 50% so far this year. So seeing a teeny bit of selling in those areas of outperformance this year. This is an interesting one. Cal-Maine Foods, largest egg producer, hard shell egg producer in the country, reported earnings. It is. The
persistence of it.
Right. The cost of feed going up. The company missed on earnings yesterday. Shares getting punished, down 13%. Worst day since 2008. The good news is, though, is the avian flu outbreak that hit the company earlier this year. No signs of that as of yesterday. And then checking in on shares of MicroStrategy after selling some Bitcoin yesterday, down 1.2%.
Are they back to being a software company, or they're still in crypto?
I think they're still in crypto.
All right, well, we got a lot to cover on this show. We're going to get through some of those names deeper, but we do want to talk, I think, more broadly about, some of the issues, and you kind of touched on this. And a little bit later, we're going to interview Stephanie Kelton, one of the great economic minds out there, and really talk about going forward. There is a big fiscal situation going on right now in Congress, or at least is going to go on when the new Congress takes over, that I think the market is going to have to reckon with. And it'll be interesting to get her insights into just where we stand with deficit spending and the whole deficit myth, as the title of her book once was, and how that fits in this current inflationary environment.
Right. If you think about MMT, right? Go back in 2019, she was a Bloomberg 50 because of her really being such a supporter and bringing it to the forefront when it comes to conversations. I caught up with her, just a little tease, in the makeup room, and she said, there's been these massive spending programs coming out of Congress and the Biden administration. The thing is, are they really spending plans, or is it if people choose to actually tap into some of these incentives?
All right, a great conversation coming up, and you flagged us a little bit earlier. We're going to take a closer look at the situation in Ukraine, a war that, of course, is now almost heading towards the one-year mark in February, a war that I think a lot of people thought would have been settled by now.
Yeah, I think the big question is, what does it look like in 2023? If you think about the way that it upended markets, not just energy markets, but completely changed the way that people are thinking about investing in Western Europe at this point as a result of the instability there. We thought it would be over in a few weeks. The war continues to drag on, unfortunately.
And just quickly, for 2023, we already know what it looks like for some workers at Goldman Sachs. Some of them are going to be losing their jobs. So that is a most read. We will get into that a little bit later on.
All right, well, let's get back to the broader markets. I'm pleased to say right now, joining us in studio is Erin Gibbs. Great to see you in person. Of course, she is Senior Partner and Chief Investment Officer over at Main Street Asset Management. Happy holidays to you.
Happy holidays.
It hasn't been a happy holidays for the market so far, despite the rally that we're seeing today. But a lot of people looking forward to 2023. The overall, I guess, general consensus is that maybe the first few months, first couple quarters could be a little bit rocky, but there might be a light at the end of the tunnel in the second half of the year. What are you anticipating?
Right. So right now, when we're looking at just profit expectations, what we're expecting the broad market to do, profits are expected to contract for the first 2 quarters. So we'll see those negative profit growth, and then it'll slowly start picking up in the second half. Now, still the outlook is not exceptional. We're looking at 4% profit growth for next year for the S&P 500, which is most likely going to be below the rate of inflation. So, net, they will ultimately be making, in inflation terms, less money. But you've really got to pick apart the winners and losers for next year, because when you start diving into different sectors and really even breaking it down into different industries, there are some very clear winners where companies are expected to have extraordinary gains, and their expectations have been very stable, and then other industries that are just being devastated.
Do you believe in a lot of these sort of, I should say believe, but I guess do you follow some of these sort of almanac narratives, the idea that, well, when you have a down year like we're having today, where we're down like 20% on the S&P, that historically you're going to get a gain in the following year?
Yeah, so about 75% of the time after a down year, so 75% after a down year, you get an up year, and the median return is 20%. So if we followed statistics perfectly, next year we get 20% return.
You're smiling big time.
I feel like there's sort of a caveat or a fuck there.
Now, the likelihood, yes, of there being right on the dot. But look, the only 2 times that we've ever had back-to-back losses in the S&P 500 was 74 and 73. So obviously a very different world of very persistent high inflation. And I think
none of us were alive for that.
Yeah. And then also 2001, 2002. Yeah. Now, the good thing, if we're comparing to the aughts, the early 2000s, the valuations were astronomical. We're talking like 40 times, 30 times, and we're trading at 17 times forward PE. Yeah. So the likelihood of, having to correct like such an overcorrection of that is just, we're already there. We're already down towards fair value. Yeah. So,
but does price come down more, or do earnings move up at some point?
So at this point, even if earnings are revised even slightly down, we're still looking at healthy valuations. So at least I think it's more that it's less likely that we're going to have another negative year, just because we are already getting to somewhat of a cheap valuation. There's more potential for upside if the market does do well.
From an industry group perspective, where do you want to be in 23? If we look at hindsight for 2022, energy was certainly where you wanted to be. Where do you want to be in 23?
So I'm looking at, that was two industries that are really standing out are, entertainment, hotels, resort, leisure. They're looking for 140% gains for next year. So still coming off of that pandemic slowdown.
Yeah, anyone who's looked at hotel prices over the last few months would certainly understand that. The question is, are consumers going to continue to pay for that, though?
Certainly the expectations are that's the one thing that consumers are still willing to pay for. They may not be going out and buying, car expectations, houses, all of that people aren't, but having time to go out and enjoy yourself, vacations, that type of thing, it seems to be the one persistent area that consumers are willing to spend on.
Erin, 2022 was one of those years where so many things that were unexpected happened. And I think about, Romaine was saying at the top of the show, here we are, the Russian war in Ukraine. It's almost a year in. Nobody thought it would go on for this long. It came out of nowhere, and it really turned things upside down. Is there something that you have on your radar that says, obviously you can't predict a black swan, but is there something that you're watching closely that could cause some troubles again next year?
Well, certainly, obviously, China. That's if they don't recover, any type of global recession will be extended. Because they are obviously a very important part. And so, we've already seen oil changing today just on reopening. So I think them being willing to reopen, getting their economy back up and running is certainly, a possibility. Yeah. If that doesn't happen, we could see the recession in the U.S. much more protracted.
There's also a question about the relationship with China, the economic relationship, and we know at least that's somewhat fraught right now. Yep. And I'm curious, though, at least for U.S.-based investors, is China something they can really count on, whether it's the consumer growth that they have there and how that feeds into U.S.-based companies, or even the U.S.-based companies that depend on them for manufacturing and assembly?
A la Tesla, Apple.
Yeah.
Right?
Yeah, more so on, it's really just a few technology companies where their revenues are important in China. Yeah. It's really about the products and basically the parts, the supplies that are coming from China into the products in the U.S. that are what's going to be driving, a lot of the productivity here.
Erin Gibbs, good to have you with us this afternoon. Thanks for swinging by the studio.
Thank you.
Happy New Year. Appreciate it. Erin Gibbs of Main Street Asset Management. Now, keeping you up to date with news from around the world, here's First Word with Madison Mills.
Thanks, Tim. The Housing Works Cannabis Company will open New York State's first legal retail weed shop right here in the Greenwich Village. This morning, leadership offering remarks on the historic legal dispensary.
Legalization for us has never been about just freeing the plant. Recognized really early the intersectionality of this issue, the way that we could use this fight to uplift other fights, other voices.
The preference for justice-involved individuals is a defining feature of New York's cannabis legalization. The first 36 license holders all having some connection to previous criminal prosecution for illegal marijuana sales. And Defense Secretary Ben Wallace said UK ministers won't be held to ransom by those striking workers calling for more pay. That assertion comes as the country faces a wave of strikes at hospitals, railways, and airports. Wallace says the military standing in for border force workers at British airports was pretty efficient. The minister added, quote, overall, we're not seeing any disruption here to people's travel. Staying in the UK, consumers vowing to cut back on restaurant meals and non-essential shopping next year. That's according to a poll from KPMG. It found that people feel the need to reduce spending and save more because, of course, inflation. And Brazilian soccer legend Pelé has died at 82 years old. Pelé helped Brazil to 3 World Cup championships and was long regarded as the best player in the world's favorite sport. According to the Associated Press, he had undergone treatment for cancer since 2021 and died at a hospital in Sao Paulo. Global news 24 hours a day and on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg.
All right, Maddie, thank you so much. Madison Mills there with First Word. And just thinking about, we talked about this before we got started, Pelé. For many of us, watching him play, that was the beginning, certainly for me in grade school, playing soccer after school. I mean, 2 decades playing, and just an incredible one, and who really brought I feel like the sport to the world.
Yeah, I mean, definitely here in the U.S. where soccer really wasn't a big deal back then. Not only did he introduce a whole generation of folks to it, but I don't think it could be understated just how much of a superstar. I mean, before there was the Michael Jordans of the world and Tom Brady's and all these, Lionel Messi. He was a big deal, a huge deal. And not only that, he was one of the first big sort of black sports superstars out there. You know how old he was when he won his first World Cup?
Yeah. 17. 17.
Gosh, Tim.
Sorry.
You're such an overachiever.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Welcome back to Bloomberg Markets here, a special edition on this holiday shortened week. And a look right now at Wall Street and the labor picture there. Goldman Sachs, we're told, is now working on a fresh round of job cuts that are expected to be unveiled in just a matter of weeks. Remember, this follows up on some reporting that we had a few weeks ago here that the bank was considering cutting about 8% of its workforce. David Solomon, the CEO, in his traditional year-end message to staff, seems to be confirming that job cuts are coming. He had already hinted at cost-cutting measures in an interview with Bloomberg earlier this month. Take a listen.
It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower.
David Solomon there, the CEO of Goldman Sachs. Hannah Levitt, Bloomberg News reporter, joining us right now to talk about that man and a company that's posting about $48 billion in annual revenue, its second best performance on record, and now setting the stage up for potential job cuts in 2023. Why, Hannah?
Hey, thank you for having me. So, yeah, even though Goldman is on track to post its second best revenue performance, You know, there are a couple things at play here that are prompting these job cuts. First of all, it was, you know, really a tough year in the investment banking world, right? It was a slowdown of, you know, M&A and ECM and all of these things, and that's a major part of Goldman's business. And then that's on the heels of also just years of Goldman expanding its workforce. It's up 34% since the end of 2018, as, you know, the firm bolstered its technology offerings and made a foray into consumer that it's now pulling back on. And so all of these things are intersecting kind of at this moment where there are going to be job cuts next month.
So Hannah, you know, as Romain mentioned, $48 billion in revenue expected this year. It's going to be its second best year ever, behind last year's record. So these are not unprofitable banks by a mile. But for Goldman, I'm curious what it means. Traditionally, as soon as they start to see some trouble, is it often that they start to cut back? Because I always feel like for workers at Wall Street firms, first of all, it's been a tight labor market, and it's also about relationship building, and that's always important for these firms.
Yeah, totally. Well, Goldman traditionally does kind of annual calls of their lowest performers, and that process was on hold during the pandemic years. And if you remember, you know, it was just a year ago that it was the war for talent, and these things couldn't, you know, get enough people in chairs, and that changed rapidly, especially in the IB world. So, you know, some of this, and we're seeing this not just at Goldman, but across the street, that kind of the resumption of normal calls is happening, but also, you know, clearly 8% goes beyond that.
Well, let's talk about what's happening throughout the street, across the street, as you mentioned, Hannah. Morgan Stanley, Credit Suisse, Barclays, they've all either already fired staff or at least announced they would. How should we read into what we learned about Goldman this morning and what other banks could be planning or are planning?
Yeah, totally. Well, as you mentioned, there have been, you know, reductions across the street. I think Credit Suisse would be the other kind of biggest example, but there were some at Morgan Stanley and, you know, just, yeah, lots of places. But, you know, first of all, Goldman has those unique kind of Goldman-esque things that I mentioned that are at play. But on the other hand, people will be watching this closely because what happens at Goldman can be kind of a harbinger of things to come elsewhere.
Is there any sense here, Hannah, that, I mean, we talk about this kind of being, to a certain extent, a little bit of a return to those annual calls here, at least based on some of the reporting that you and your team have done over the last few weeks. This does seem to be a much higher, at least on a percentage basis, than what we had seen in some of those pre-pandemic calls.
Yeah, absolutely. And I think that can be chalked up to, I mean, the kind of change in strategy around consumer and things like that. And also just, I mean, the amount that firms, not just Goldman, really built up their ranks over the past couple of years. And, you know, if there's kind of a equal or, you know, commensurate pullback.
Yeah. All right, Hannah, I got to leave it there. Thanks so much for taking the time and joining us this afternoon. Bloomberg's Hannah Levitt on the latest with Goldman Sachs. Well, let's stick with Wall Street for a moment and talk about what happened last year. When the year began, there was the faith that inflation would fade and the Fed would actually hold rates low. But then came a brutal market collapse that blindsided some of the biggest firms. I want to bring in Emily Graffeo for more on the Bloomberg Big Take today. Emily, if we think back to a year ago, we had a couple analysts who were predicting that we'd end the year a little differently, perhaps above 5,000 on the S&P 500. I look up there right now, we're not even above 3,900. Been a brutal year, down more than 20%. A moment of reckoning for some of the most bullish analysts on Wall Street?
Yeah, I would say so, Tim. My colleagues and I, for our big take in Bloomberg News, we started researching this story by looking at the outlooks for 2022 that strategists and fund managers were putting out at the beginning of this year and at the end of last year. And it was really shocking to see where everyone was expecting inflation to go and the path of rate hikes. The consensus view was we were going to have about 4 25 basis point rate hikes, and we had 17. So that in turn led to the S&P 500 price targets that were really off, and in turn led to the market declines that we saw.
To be fair, a lot of people got it wrong, right?
Yes.
I mean, we were in a very different feel and environment at the end of last year. How did you guys single out two individuals on Wall Street?
So the two gentlemen that we started the story with, Marco Klanovic and John Stoltzfus, they had two of the most bullish S&P 500 price targets. Stoltzfus from Oppenheimer, his was the largest. It was 53.30 at the beginning of the year, and he held on to that price target for a very long time, brought it down a little bit, but even in July, I interviewed him, and he was still saying we could get that Fed pivot rally soon. We're closer to the end of the tunnel than the middle. So he stuck around, and Klanovic his team was fairly bullish throughout the year as well.
So I have a lot of quibbles with this story. I mean, I get the idea that there were definitely some sort of a black swan type things. Obviously, I don't think anyone could have seen what would happen with Ukraine and the reverberations from that. But I do want to go back to the Fed and Powell, because you lead off the story with that. When he got renominated or re-upped, whenever that was, like in November of 2021, that first big meeting that he had, I think it was in mid-December, he said, flat out, we need to fight inflation, and it's very possible we're not only going to raise rates next year, but we're going to do so at every single meeting. And he did that. So is this about people weren't prepared for something, or they just didn't listen to the guy who effectively runs our economy?
We interpreted it as people not listening. What we looked at years of history and spoke to a lot of strategists who spoke very openly about the fact that they've grown up investing in decades of low interest rates. So they have this reflex to buy the dip. They've been learning this instinct that stocks will always go up. The Fed eventually will come in to save the day.
Fed put, right?
The Fed
They're always going to protect financial markets.
This was the year that the Fed put effectively died, but it took a while for people to understand that the Fed put was dead.
Is it dead forever?
Well, it's interesting to look at where the market is pricing for the Fed funds futures for 2023, because certainly Powell has said that he's not going to cut rates, but the market, there is still an expectation that there will be a rate cut next year.
I mean, we talk to people all the time
I'm
who
curious,
think they're going to cut rates.
Yeah, but when you talk to some of these investors, are they of the mindset that what's happening now, it isn't just about fighting inflation and raising rates, it's also about this idea of sort of a renormalization of what monetary policy used to be. Zero bound rates is not normal. Now, if you're under the age of 35, yeah, that looks normal to you. But who in their right mind thinks that for the next 50, 60 years, we're going to stay at zero bound?
Yeah, I've heard a lot of people use the phrase regime change, regime shift.
Yes.
There is a growing consensus, at least from my sources, that we are heading into a new regime where inflation is higher for longer, rates are higher for longer, and so that's really going to affect how people position their portfolios. It could upend 60-40 if it hasn't already been upended, but people are noticing that we might be seeing a larger shift than just 1 year of a decline in the S&P.
Emily, just quickly, your conclusion after doing this story.
My conclusion is that there are some strategists that still don't think the Fed put is dead. It's maybe the lesson hasn't entirely been learned after this year.
I don't count you in that camp, Romaine.
No.
Simple answer.
We'll see. We'll see what happens. We've got a lot of great guests that we can kind of dig apart this story. It's a great read as we get ready for it.
And when you talk about a terminal rate, if you get at 5%, this whole idea of a pivot, right? If this really is about the fight of inflation, and that does it, and that lagged effect shows up, there's no reason for them to do anything else.
There was a good point made this morning about when you look at the weekly job list, because they're still staying low. This whole point that a lot of jobs that are being cut are white-collar jobs. They get severance. It's not going to show up for some time. This is something that Jay Powell talks about that will show up in data.
Emily, do you still believe in Santa Claus?
Of course.
There you go.
There is no
the rally is here.
There is no Santa Claus?
Well, stocks right now, right around the highs of the day. 1.9% on the S&P 500. Carol Masser, Tim Stenovic, Romaine Bostic. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
This is Bloomberg Markets Close, almost 2:30 here in New York. Let's get you a quick check here on what's going on in the commodity space. Watching settlement of a wide variety of commodities right now at this time. It looks like WTI crude going to settle down for a third straight day, down about 0.7%, right around 78.39. We talk about the big round trip that we've seen in the oil market. Of course, we saw double-digit percentage gains to start the year through May, and of course, that's all faded. Still up about 4% on a year-to-date basis. Be interesting to see some of the calls going forward. A lot of folks out there still bullish here on the commodity cycle, particularly when it comes to energy. We're going to talk about that in just a second. Some of the optimism that we saw in the industrial metal space has faded a little bit because of the rocky reopening of China. Copper futures a little bit lower here on the day. Natural gas futures here in the U.S. pulling back. And keep an eye on some of the cocoa and coffee futures pulling back a little bit here on the day. A lot of this has to do with a lot of expectations, and a lot of the positioning, the bullish positioning now appears to be on the wrong side. Slightly lower here on the day, 1.4% decline here for cocoa for March delivery. That's out of London.
Well, for more on today's commodity moves, joining us is Simon Casey, Deputy Managing Editor and Team Leader for Energy America's coverage here at Bloomberg News. He joins us from here in New York City. Simon, good to have you with us this afternoon. Romaine mentioned the round trip that we saw this year. Oil starting the year off at 75. Now we're at 77 with a hike of up to $123 per barrel at one point in March. I want to get to the big picture later and first talk about the lack of bullishness that we're seeing after last week's move over excitement that China's reopening would lead to a demand in crude.
Yeah, I mean, it's proves of fairly short-lived in the end, really, this sort of the Chinese reopening and this idea that this would trigger another sort of run up. We have to say volumes this week have been very, very thin, as you might expect, just after Christmas. But there's some concern about possibly, the COVID outbreak in China actually, for now, keeping a lid on demand there, maybe possibly even spreading around the world. Although, as we've seen so far, there's been no indication that there have been new strains of COVID discovered. But the pitch is kind of muted right now. We had some key inventory data out today in the U.S., weekly reports. We expected an inventory draw. We actually got a small, modest inventory build. So that's another data point that was a surprise. It was a bearish surprise. So it's just keeping a lid on sentiment right now.
All right. So what do you think? I mean, can you at this point, Simon, get a good feel of what you think could be one of the big themes when it comes to the energy trade next year?
I mean, if I could successfully predict oil prices, I wouldn't be sat here. No, look, it's
no offense taken, Simon.
No, none at all. I mean, look, it's still very volatile. Yeah. I mean, I think that's the big lesson of this year. If you could sum it up with one word, it's volatility, right? And we still see all the ingredients for another volatile year in 2023. We have this war in Ukraine. There's no end in sight there. We have a price cap. We have Russia threatening to come back in the new year with some kind of further measures. We don't know what. They could possibly constrain production further and try and support international prices. That's one possibility. We have Saudi Arabia and OPEC, who've been tremendously successful this year in supporting the price at times of weakness. So that's just a couple of factors right there to consider.
All right, Simon, so appreciate you weighing in on this Thursday. Simon Casey, Deputy Manager, Team Leader for Energy America's coverage here at Bloomberg News. We're going to stay with this. That's kind of our backdrop because this energy markets we've watched so closely this year thanks to the Russian war in Ukraine. I mean, it was one of the big unexpected events of the year. We know today we saw another round of Russian missiles really coming down on Ukraine, one of the biggest and heaviest barrages of the war. So we want to talk geopolitical, the impact on commodities and markets. We've got a great guest to do that. Ed Price is with us. He is principal for geopolitical forecasting at Ergo. It's a global consulting and forecasting firm. He's a former British trade official and so much more. We welcome him here in our studio. Hey, Ed, good to have you here with the team. So how do you gauge the geopolitical events? Specifically, let's start with Russia and Ukraine. Do you think we get an end to this war next year? What are you telling your clients?
Thanks, Carol. So we're telling our clients right now that we're in a state of stalemate, meaning it does seem that this war has reached the sort of point that neither side can conquer the other, right? No, we don't expect Kyiv to march on Moscow, nor do we expect the opposite successfully, at least. But of course, this war has to end. It's not possible for this thing to keep carrying on in the way that it is. And so as you go through...
And yet it's gone on much longer than we all anticipated.
Which is kind of what we wanted after we sent those weapons, no? I don't know, right? But at some point, we don't want that anymore. We want it to end.
Right.
And so I think what you have to do is take very seriously someone like Putin's threats of nuclear escalation. Even if they are low probability, they have a very high potential risk outcome. So you have to watch them as asymmetric risks.
But what does an end look like here? Because right now, at least to the outside observer, there doesn't seem to be an opening. You have someone in Putin who doesn't seem like he's interested in negotiating, and for that matter, Volodymyr Zelensky has said the same thing. And you have a country in Ukraine that has been decimated, an economy that's been decimated. So even if Ukraine wins this war, and I put that in quotation marks, what does the future look like for them?
I think you're making a profound point here, because define win. Now, we're looking at Putin and saying he wanted to conquer the whole of the country. Maybe he did in period one. We're in period two. And now maybe he places some kind of premium on disruption itself, on carnage, on human destruction. You know, maybe a rule of thumb for one way that this war ends is which one of these presidents is assassinated first, right? The first one that gets a revolver to his head. Maybe it's Putin, maybe it's Zelensky. That's a real dynamic. Again, low probability in each case.
Just a clear hypothetical here, though. If for some reason Putin was not there, for whatever reason, is that a better scenario for Russia? I mean, are the people who would fill his shoes, are they any better?
That's a great point.
Do they have a different ideology?
Yeah.
I think anyone that fills Putin's shoes will be wearing Putin's shoes, right? To riff on your point, and will continue with this ideology of nationalism and militarism, indeed imperialism in Russia. That will continue. Is that good for the Russian people? No, right? It's not good for them at all. But if you mean will someone else be more successful in the assault on Ukraine? Possibly.
Ed, I want to go back to your comment about nuclear weapons. Even though it's a low probability, the outcome would certainly be disastrous. What should the world do to prevent some sort of outbreak of nuclear war? Is that what you say a risk is?
Well, the outbreak of nuclear war is always a risk, right? I mean, growing up, we knew this, and it never went away. It was an illusion.
It did, but it did sort of go away with the decline of the Soviet Union.
Or indeed,
and this, you know, strategic arms limitation treaty, and
possibly
these sorts of things.
And yet there are stockpiles around.
There are, but the idea was mutually assured destruction.
Right.
But that wasn't true. It's actually, in fact, nuclear weapons that have now allowed Putin to go into Ukraine with such vim, right? This is a new...
And Ukraine's lack of nuclear weapons, which it gave up in that original deal.
Correct. Yeah. Absolutely correct.
So, Ed, what's the role of the developed world or the European allies, the United States in there? We know that they've already been, understandably so, helping out the Ukrainians when it comes to weapons. So what is the role of the developed world, do you think, going forward? Do they continue to do that, or do they somehow help assist in maybe bringing some kind of conclusion here?
Well, again, we have assisted Zelensky to the point that it's maybe immaterial how long-range his weapons are if he can get right up to the border. We have assisted Zelensky rhetorically, materially, politically. That kind of depends on who's in the White House. Right? So if I imagine that one of Putin's lifelines is what happens in 2024, there may well be another president, perhaps unmentionable, in the White House again, and at that point, all bets are off.
Interesting. I do want to pivot from Russia to another geopolitical issue, and that involves China and Taiwan. There's obviously there's a lot we don't know, but a lot of speculation about China's ambitions when it comes to Taiwan, and more importantly, whether it's going to actually try to make good on that anytime soon.
Well, look, if China wants to use force, it will use force. The thing to think about is that twofold. One, China thinks in longer chunks of time, so the when question is different. There's a lot of discussion in the American military and intelligence community about a 5-year window, maybe, but again, that's maybe Xi Jinping's personal window. I'm not sure it's China's window. But again, it depends on how prickly Taiwan becomes. But then two, I think people have something of a misconception about this issue because it's very myopic and it's very dichotomous. It's always like, okay, will China, yes or no, try and sail 1 million men over to Taiwan?
Yeah.
Okay, well, if you think about that logically, do they have to strike U.S. assets in Japan first? Right, maybe. Yeah. Do they have to strike at Guam? Do they have to strike at Pearl Harbor, right? I mean, this is, you can't just take your army and like float it out into the ocean. That didn't work for Napoleon, it didn't work for Hitler, it didn't work for
There might be other things. I am curious, do you think that the international response, let's just assume, hypothetical, that there was some sort of military movement by China towards Taiwan. Do you think the international response would be more swift and more united than the way it was Ukraine? Because even for all the support we gave Ukraine, a lot of it was lip service for several months.
Well, what we were doing for Ukraine was on the hop, right? It was like ex post. We had an uh-oh moment, and we started shipping this stuff in quickly. I think that the Taiwan response will be, because of Ukraine in part, ex ante, beforehand, right? So I imagine we're going to start seeing more in the way of arms being funneled into Taiwan. Now, will it be the sort of long-range stuff that we didn't want to give to Zelensky? Probably not. Because that would be considered by the Chinese as a real threat.
But just, again, what you say, what happens maybe Russia and Ukraine in terms of who's in the White House, same thing for China, right? Is it different?
Well, Xi Jinping, I think, is a fixed element. I mean, he.
But I mean, in terms of who's in the White House come the next presidential election, do you feel like anything changes in terms of policy from the United States?
No, I think this is
it.
This is it.
And it's been remarkable to see that one area of policy that President Biden has continued with is what Trump established in regards to China. There's been a continuation there. You've laid out a couple scenarios for us that are, I think, mildly disturbing for people who are listening or watching us right now.
Well, Tim actually put in our IB chat, he said, this is mildly terrifying.
It is.
Mildly, only mildly. I'm terrified.
It was an understatement.
He was being sarcastic.
Is there anything that we can end on that's sort of optimistic about how we can avoid scenarios such as you describe?
We don't need to avoid those scenarios because Uncle Sam comes out on top. So there's your optimism. It would be nice to, but thank God we have the equipment and the inventory and the military power that we do.
But you're talking about this in the context of using force in all of these scenarios, or is it deterrence because of the force that we have?
Strategic ambiguity, who knows, right? But I think that if you want an optimistic note, one thing we've seen from the war in Ukraine is that Uncle Sam packs a punch. I mean, I didn't even know the switchblade was a thing, but it is.
Yeah.
I feel like Tim is getting ready for his bunker. Hey, let me ask you, let's flip to what our audience, they obviously care about the geopolitical, but they also care about how it impacts global markets. So how do you think about 2023 with these two major big issues, whether it's Ukraine, Russia, or China? How do you think about it for the investors and what that means?
Sure. I mean, your last caller, Simon, confessed that he can't read the future. I will confess the same.
Yeah.
And I will copy his word volatility. Volatility, by its nature, is in either direction. So I think we're going to have to be slightly less passive, slightly more active, whatever we're doing. But the context behind all of it is not just what's happening to supply chains in Ukraine. It's also the Fed. And the tightening cycle. So I'm one of the economists that thinks to himself, yes, we're seeing this sort of lingering ember of a belief that QE is a thing and the put is a thing. I don't think so. I think they're going to have to keep going.
All right, Ed. Well, great conversation, even if it was mildly alarming to Tim there. Great insights. Ed Price, Principal for Geopolitical Forecasting over at Ergo. And we're going to transition from that conversation to the Bloomberg First Word with Madison Mills.
Thanks, Romaine. The U.S. Treasury Department signaled some imported cars will qualify for electric vehicle tax credits in the Inflation Reduction Act. That move could relieve concerns about the sweeping climate legislation. The Treasury sketched out its interpretation of content requirements for tax credits today. However, officials have until March to finalize the rules of the law. And it was one of the more significant disruptions to Twitter since Elon Musk took over. The platform has restored service hours after thousands of users worldwide reported glitches and other issues. Musk said Twitter had rolled out changes to its server architecture. And China says it's up to the U.S. to take steps toward resuming military talks that were suspended after Nancy Pelosi visited Taiwan. At a briefing in Beijing, a spokesman with the country's defense ministry said the U.S. can't expect discussions to continue while, quote, constantly harming China's interests. Tensions remain as Washington supports Taiwan militarily, and Beijing has pledged to bring the island under its control. And reminder, Brazilian soccer legend Pelé has died at 82 years old. Pelé helped Brazil to 3 World Cup championships and was long regarded as the best player in the world's favorite sport. According to the Associated Press, he had undergone treatment for cancer since 2021 and died at a hospital in Sao Paulo. His official Twitter account writing this afternoon, "Inspiration and love marked the journey of King Pelé, who peacefully passed away today." Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg.
Thank you, Maddie. More on Pele after the break.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Sydney. From Washington. In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, welcome back to Bloomberg Markets. Before we get back to markets and what's going on in the world of finance, we do want to turn our attention, of course, to the world of sports, I believe, Carol Masser.
Yeah, we do. This, as you said, markets are a little bit higher. We'll get back to that in just a moment. But as we've been talking about, Brazilian soccer legend Pelé, winner of record 3 World Cups, dying at the age of 82. So we did want to get a little bit more from our Bloomberg News Latin American reporter, Andrew Rosati. He joins us now from Rio. Andrew, you know, we were talking earlier, for all of us growing up, Pelé meant we went and played soccer. He brought the game to the world. Give us, you know, what's top of mind as you heard about his passing.
Well, right now in Brazil, you know, there's just an outpouring of condolences coming, you know, from all over the spectrum. You know, President-elect Lula's cabinet is quickly sending out condolences on social media. Former players that joined him on the field and other soccer greats are all chiming in, saying how important he was to them and the game and Brazil in general. Pelé here is often referred to as simply the king because he has such a huge cultural significance here for Brazilians of all stripes.
How will he be remembered? What will his legacy be?
You know, I think one thing about interesting when you think about Pelé, when you talk about soccer, the greatest ever, whether it's Lionel Messi, Diego Maradona, they're always mentioned in the same breath as Pele. So, whether or not he was the greatest, that's just still for many up to decide. But Pele is always there, and I think this will continue. He will always play off in these breaths where I'm talking about.
Any sense so far as any sort of arrangements that have been made to not just for his own personal funeral, but also any sort of celebrations of his life out there?
So this is very quickly developing. Pele had been battling cancer for well over a year now, and his family had been by his side in the hospital in Sao Paulo where he's convalescing. And we just got the news out from, his family was put this out on social media. We're still waiting for, President Lula to chime in and others to say what the official thing is, but I can assure there will be a lot in the days to come.
All right, Andrew Rosati, catching us up here on the latest news regarding Pele passing away at the age of 82. We call him a soccer star, but really he was one of the first mega sports stars that we've known, at least here in the modern era. We're going to make a hard pivot from the death of Pele back to economic conditions, both here and abroad. And, we talk about the economy in terms of charts and numbers and data and all that, but it's also, of course, about ideas and dialogue and discourse. And one of the people who has really helped to further that dialogue and discourse with some very intriguing ideas is Stephanie Kelton. Pleased to say she's joining us right now, professor of economics and public policy over at Stony Brook University and the author of the best-selling book, The Deficit Myth, which I think brought a lot of non-economists, non-wonky folks into this fray of some of your ideas. I want to start off talking about fiscal spending here and the years and years and years that we've been beaten over the head, at least in this country, with the idea that austerity was necessary. People looked at the lower interest rate environment, they say that couldn't last. They look at deficit spending running in excess of the servicing costs on that debt, and they say that couldn't last. So here we are. Those arguments have been made for years, decades. Here we are in 2022, heading into 2023. Low interest rates are gone. The other component of that argument for austerity also seems to be wavering.
Well, you're absolutely right. I mean, there are, as you rightly point out, we have been listening to the same sorts of arguments for the better part of my adult lifetime, right? There's always a fiscal crisis. It's always right around the corner. You always need to rein in the deficit and get spending under control, and then you finish the sentence. And how you finish the sentence changes over time, right? When it was the Greek debt crisis, that was the canary in the coal mine. We were going to end up like the Greeks. If it's, something happening in some other part of the world, you look at the UK more recently, there it is, right? There's the canary in the coal mine. So, what I tried to do in the book is just to say, listen, there is a case to be made for tightly regulating the amount of money that governments commit to spending into the economy each year. But the distraction is, does it add to the deficit? And the debate that we've been having for so many decades is always about how will you pay for it? Where will you find the money? And what I tried to do in the book was to say that's the wrong question. Mm-hmm. The question we should be asking is, how will we resource it? So it's about capacity constraints. It's about inflation. And, I worked in the Senate for a period of time. And I can tell you my great frustration in that job was never having heard a single member of Congress or a staffer talk about inflation risk. They'll talk about multi-trillion-dollar spending bills, but never bring up inflation. And for me, that was always the core of the issue.
Well, okay, so here we are in this environment. Inflation, yes, it's come down. Some saying it's peaked if you look at some of the data points, and yet it's a lot stickier at a higher level than many people are used to. So how do you think about it against what the U.S. government is doing in terms of spending or constantly raising the debt ceiling? Is that problematic in terms of the inflation picture that we are in today?
Okay, so first on the sticky question, I think that this is an open question, right? How sticky inflation is going to be, because we are seeing inflation decelerate. In the goods side, we're actually seeing prices come down, right? We've got deflationary pressures there. So we're more focused now on the service side, and I know there's a lot of attention at the Fed about what's happening with wages, and I think that's really what you're getting at when you talk about sticky. How sticky is the wage pressure? And I guess the good news there is that wage inflation is also decelerating. So
So you're not worried?
Well, I'm always worried. So for me, inflation is always the thing.
She's always worried.
I'm always worried, and for me, inflation is always the thing I worry most about, right? The second chapter of my book was called Think of Inflation. It was like I was begging people, will we please, for once, start thinking about inflation, because I think we got complacent with the last several years of low inflation and thinking inflation's a problem of the past. We'll never have to worry about it again. And if it does ever rear its head, central banks have this. They have the tool. They can dial inflation down. It's easy to handle. And I was making a really different argument.
Well, Stephanie, it seems like if we think back to the last two times we heard Fed Chair Jay Powell speak, he took policymakers to task when it came to employees and immigration. And he didn't come out and say that he recommended certain policies when it came to immigration. But one way that he could be less concerned about the employment market right now is perhaps if we do bring in highly skilled workers who can fill some of these jobs that companies are looking to fill. What would your recommendation be to policymakers to help prevent a wage price spiral as a result of companies just not being able to find workers?
Well, that's a big part of it. In April of last year, I wrote an op-ed for the New York Times, a fairly lengthy piece, and I laid out a whole suite of anti-inflation sort of tools that go beyond what the Federal Reserve can and will try to do. And one of the things that I bring up in that piece is exactly what you just mentioned, immigration policy. Badly broken. We all know it. It's been broken for so many years. So would that help to alleviate some of the labor shortages that we're talking about and hear about? Sure, it would. I think the Biden administration was also on the right track when it was talking about childcare. And millions of people say the reason that I'm not in the labor force today is because I'm having issues finding affordable childcare. There's another good one.
Whenever we talk about labor, we always talk about it in terms of participation and obviously things like immigration and fertility rates and things like that. I haven't heard a lot of discussion about productivity and increasing productivity. Is that in and of itself kind of a myth? Is that not something that's a factor in, I guess, how we respond to these labor shortages?
Gosh, that's like if you could unlock that and solve the productivity problem, it would deal with so many other challenges that we face. And economists for a long time have said...
Are the productivity measures that we look at, are they reliable?
I think more or less. I mean, there are problems. We're starting to question lots of data like job openings and how much, is this getting right or wrong. But I think the productivity is more or less reliable. I think if we were doing more to invest in R&D, in infrastructure, in education, those are the kinds of things that boost long-term productivity. But of course, it takes time, right? Productivity is not, there's not an easy thing that you dial up to get productivity growth to shoot higher. But we can certainly do things.
We've got about a minute left here. We've talked about the I word. We've talked about the P word. Let's talk about the R word, recession. How worried are you?
I'm worried. I'm worried.
Meaning deeper, wider, longer? What are you worried about specifically?
Well, okay, so...
In just about 40 seconds. Sorry. Maybe 60.
I'm worried that the stars might be aligning in such a way as to push us to a situation where recession becomes almost unavoidable. I hope it doesn't happen. I still
But is it
find
touch
myself,
and go? Is it touch and go?
It's touch and go.
But is it a touch and go recession? Felt it? Gone.
I would like to believe so, but that would not be my base case. I would like to think that the soft-ish landing is still, that there's still reasons to be hopeful about that. Look, I think that the thing that gives me a little bit of reason for optimism is really on the fiscal side. We've got the bipartisan infrastructure package, we've got the CHIPS bill, and we've got the so-called Inflation Reduction Act. Now, that has the potential to add a lot of support to the economy at just the right moment in the years ahead. So we'll see where we end up.
All right, Stephanie Kelton from Stony Brook University, the author of The Deficit Myth. Thanks so much. Coming up, we're taking a deep dive into two stocks that burned traders in 2022. This is Bloomberg.
AI is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
This is Bloomberg Daybreak with links.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Big, expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Markets to close. About an hour left here in the trading day on this Thursday afternoon. Romaine Bostic alongside Tim Stenovic and Carol Masser. We had a two-day decline here that a lot of people questioning the Santa Claus rally, an almost 2% rally here in the S&P on this Thursday afternoon, giving a little bit of credence here to some of the dip buying behavior that has started to twinkle up in this market over the past few days.
Broad-based, we've talked about it, right? But it's getting pretty quiet. It's been quiet all week here, but nonetheless, nice to see a little bit of greenness certainly for those bulls out there. You really, as we said, pick your name. It feels like investors are willing to take on some risk today.
I was looking through just some of the sectors. I mean, you take a look at the IGV, which covers the software sector, up about 3% here on the day. But then you go through some of the names. You talk about the big rebound in Tesla, which was up as much as 10% on the day. I think only up now
You're gonna say when
about
it's still
5-6% here. Oh, it's still one of the worst performers on a year-to-date basis. Then you have Netflix, which had one of the worst first halves that it's had in a while. But in the second half of the year here, I think it's something like the third or fourth best performing stock in the S&P 500, up about 5% here on the day. And I think you brought this stock up a little bit earlier, was Cal-Maine Foods, big maker of eggs. If you buy eggs, you're probably buying it from them, even though it's not branded as Cal-Maine. And I thought some of their commentary, Tim, about feed costs and those input costs was quite telling. And anyone who's bought eggs lately knows that's where
I even
the real
saw people
inflation
tweeting about egg prices this morning on Twitter. But there could be some good news. It could be those prices could be coming down as a result of the avian flu outbreak not being as apparent as it was a few months ago. But the feed price is still a big concern. Those inputs, the inflation story is here to stay.
And this is going to be a big topic of debate as we head into 2023, even if you do have this certain degree of moderation as to sort of what's going on. At some point, you get to that level where, well, not everything is necessarily moderating, right?
Right, exactly. I don't know. Every time I feel like I pay for something, it certainly feels pretty high. The other thing we should point out as we get ready to talk a little bit more about the U.S. economy is U.S. jobless claims that we got today, right? They rose slightly, but still near historic lows, which is to some, maybe which is why we've got this rally underway, that people are saying maybe growth won't take such a hit when it comes to the U.S. economy. Could we see that soft landing?
All right, let's talk a little bit more about the economy and economic conditions. We just had a wonderful guest in Stephanie Kelton, and we said, who can we get on to actually top her? Peter Atwater joining us right now, adjunct professor of economics over at William & Mary. He's also president of Financial Insights, a consulting firm that advises institutional investors. And really, those titles, I don't think, do him justice. I mean, we talk about just sort of all the progress that's been made over the last few years in the study of behavioral economics and just social psychology when it comes to the markets. And Peter Atwater's name comes up time and time again in that research and dialogue. Peter, we talk about recessions. We talk about the economy. It's been said before that the economy really isn't a number. It is a feeling. And if a lot of people out there are looking at the egg prices in the store or looking at other things at the store, even if their wages are going up, even if everyone says there will be no recession, if they feel like things are bad, things are going to be bad, right?
Yeah, the economy just mirrors our mood, and it's a lagging indicator from my perspective. We act as we feel, and you really saw that earlier this year with gas prices. I mean, you talk about a supervillain as far as sentiment, and the connection between gas prices and consumer confidence this year has been spectacular. I mean, you could really see the pain at the pump weighing on consumer sentiment.
It's interesting, Peter, because when we've spoken about inflation over the last year, we oftentimes talk about how it hurts people at the bottom and lower ends of the income spectrum the most. They certainly feel it more because more of their disposable income does go to these discretionary costs or these non-discretionary costs. But you argue in your commentary that in 2023, we could actually see a crumbling in luxury, a crumbling at the high end, and that people couldn't see it coming. What are you talking about here?
Yeah, so when I look across the economy in terms of sentiment, what strikes me as a retrospective on 2022 is that those at the top seem to be immune from all of the pain that was being felt by those at the bottom. You know, food inflation, energy inflation, those at the top just sort of shook it off. And what you've seen is this immense overbuilding and oversupply to cater to those at the top, as if this golden era of wealth is going to go on forever. And that typically is a sign of trouble when you have this extrapolation of euphoria that seems to be everywhere, whether it's on Billionaires Row in Manhattan or across Miami, in travel. It seems to be saturating the supply chain for those at the top.
So, Peter, if that bears out in 2023, so we see the high end also come undone and those who are paid more also feeling the pain of this economic environment, what does it mean then for a potential recession here in the United States and perhaps globally?
Well, they dominate consumption. And so I think you have to think about the implications of those at the top really struggling. And what's so interesting is that the timing stinks, because what we've seen is this demand pull in lots of hard goods and autos and in housing. And so what you could have is supply really being over generous in terms of what we're seeing starting to build on car dealer lots. And at a time when those who are most able to afford products begin to pull back. So I think we have to watch the potential for deflation, particularly at the very top.
Deflation. We haven't talked that much about that. It comes up every now and then. There are a lot of people that say, well, you have to sort of look at the energy space or the commodity space and say it's not quite what it was, I think, in the 70s or 80s when we had real deflation. Some of the other areas of the economy maybe haven't sort of round trip back to some of those conditions that would provide that deflationary spiral. What is it about this time around that you think could cause that?
Well, because we've seen sort of two bullwhip effects. When suppliers pulled back on anything they possibly could at the early days of the pandemic, they cut orders, they sold inventory, and they didn't anticipate that we would see this massive inflow of capital from governments around the world and from central banks. And so what you then saw was this rush for products at a time when they were very scarce. And that I think this mismatch, this bullwhip effect, created this spike in inflation, particularly in the hard goods and autos being probably the most prominent. And I think that we're on the other side of that. And I think you're likely to see the oversupply, because supply chains have finally rounded and things are coming in more naturally into ports and into supply chain at the time when those at the top begin to pull back. So it's a mismatch in the opposite direction to what we saw 12 months ago.
Peter, if we're looking ahead to 2023 and we're trying to predict whether there's going to be a recession or at least understand what the economy is going to look like, what is the most important indicator that you look at for sentiment?
It depends on the group. I mean, I look at stocks like LVMH as a great real-time proxy for the global financial elite, and that just continues to look very strong. At the same time, you move down tiers and look at something like Carnival Cruise Lines, which would be an upper middle class indicator of sentiment, planning for big trips, very expensive. That looks horrendous. So that gap in confidence, I think, is really pronounced. So I think for those at the bottom, this has already been a recession, and particularly if you've had to commute, which many upper middle class workers haven't had to because of work from home. They've experienced a lot of pain this year that others have been able to avoid just because they didn't have to commute and pay for gas.
Hey, Peter, K-shaped recovery, you coined the concept, coming out of the pandemic or in the pandemic, the economy coming back not equally, individuals not coming back equally. Where are we when it comes to that?
So I think that what's happening behind the scenes is we're seeing a K-shaped depletion of savings. So, there's a lot of averages that would show that the American consumer looks really good in terms of savings that they've got and cash on hand. But you start to dig into that, and that's heavily weighted to those at the top, and those at the bottom are depleting their savings if they have any at this point. And you're starting to see that show up in terms of the credit card debt volumes for those at the bottom. So that's not a great indicator.
All right, we're going to leave it there. Hey, Peter, have a great new year. Good to check in with you. Peter Atwater, of course, of Financial Insights and of William and Mary. We really appreciate your time. All right, right now it is time for a check on world and national news. Let's get to a flash. We'll get a check in with Madison Mills. Hey, Maddie.
Thanks, Carol. In Israel, Benjamin Netanyahu has been sworn in once more as prime minister. That comes after a vote in parliament approving his political return after 18 months in opposition. This will be Netanyahu's 6th term as head of government. The coalition brings together two parties and religious factions today. And European health officials called on restrictions on travelers from China unjustified. The European Center for Disease Prevention and Control said in an emailed statement that their health systems are equipped to handle the current load of infections. Beyond that, the center said the potential for imported infections is low compared to the level of COVID transmission that's already happening inside of the EU. And Serbs in Kosovo began removing road barricades that were put up in protest against the largely ethnic Albanian government. That move comes after the U.S. and the European Union increased pressure on both sides to avert a new Balkan conflict. Still, tensions remain as 2 trucks used to block roads were then set on fire, and that is according to tweets by Kosovo police. And Brazilian soccer legend Pelé has died at 82 years old. Pelé helped Brazil to 3 World Cup championships and was long regarded as the best player in the world's favorite sport. According to the Associated Press, he had undergone treatment for cancer since 2021 and died at a hospital in Sao Paulo. His official Twitter account writing this afternoon, "Inspiration and love marked the journey of King Pelé, who peacefully passed away today." Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg.
Thank you so much for that update, Maddie. Really do appreciate it. I don't know if you guys caught this story on the Bloomberg terminal a little earlier in the day. A pretty distressing one. It's about how Britain's youngest employees are too ill to work. And when we use the term ill, we're not talking they have long COVID. We're talking about mental health here, and the fact that the numbers of workers, young workers in the UK who are on the sidelines as a result of not wanting to come into work or not entering into the labor force due to mental illness is rising at a rate that has a lot of officials concerned.
Well, it's like 40% or something, right? For like 20 and 30-year-olds.
I would love to see these. It is. I would love to see these for the U.S. as well. I mean, we talked about it being in the context of the pandemic, that this was a reset for people, but according to this reporting, this was happening before the pandemic. This has been decades in the making.
Yeah, here's the numbers. 29% increase in 60 to 24-year-olds citing long-term sickness as a reason for being economically inactive. 42% jump among those who are 25 to 34, saying the same.
And I don't want to get too pessimistic here, but this is obviously something not unique to the UK.
No.
And really, but it's not something unique to the world. I mean, we've seen a lot of this in developing nations and emerging market nations, and a lot of the political instability and social instability that we've seen in certain Middle Eastern nations and African nations have all sort of linked back to this idea. It's not just really about people being angry about very specific things. It is more about sort of the chronic idea of sort of being mentally unwell and no real economic opportunity, no real social opportunities correct that. And
Japan,
now I think
one of
the
those countries
developed
that comes
world,
to mind too.
and now in the developed world, and Japan's a good point too, is now starting to feel that as well.
Well, I think, the conversations that we have just in the newsroom about folks feeling still very, very stressed, even coming out of the pandemic, and just feeling, going back to that work-life balance, or dealing with illnesses or stuff at home. It's difficult, and it's certainly troubling. And this has a cost.
Yeah, and this is a good time, too, to remind people that if you are lucky enough to have health insurance or have access to certain means to seek out a therapist, to seek out other mental health resources, it is very important. It doesn't matter who you are, whether you're rich or poor. I think we're all going through a lot of the same stresses right now.
And I'm glad we're all talking about it, too. I think that's something that's changed just in recent years. Well, coming up, we're talking more stocks, historic sell-offs, and some of the biggest names. We're going to dive into Coinbase, Meta, and more.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Well, to say it's been a hectic year is certainly an understatement, at least when it comes to equities, marked by surging inflation, interest rate hikes, and political instability. For those who traded on the wrong places, the FANG stocks, for example, the outcome has been quite painful. Among the FANG stocks, Meta suffering the most, falling 66% to date. We've got Bloomberg's Kurt Wagner joining us now with more insight. Kurt, when we think about the problems that Meta's facing, it's more existential rather than problems from higher interest rates or political instability, for for example. I mean, this is a company that is right now trying to completely reinvent itself. Give us an idea of what 2023 looks like in the context of reshaping this from a social networking company relying on advertisers to one that really is making money from the metaverse.
Well, I think we're going to have to wait longer than 2023 before we see some real returns from this metaverse bet. And I think that's part of the issue and why some investors are, spooked by Meta right now, right? Is that they are investing heavily, $10 billion, I believe it was last year. I think it's going to be somewhere in the same ballpark this year in the metaverse. But that's probably years away from showing real returns. And so I think that's where the issue is. And you mentioned, excuse me, some interest rate issues. The problem is a lot of times when there's a bad economy, marketing budgets are the first things to go. And so when you see Meta struggling right now with its advertising business, some of that is because of just the broader slowdown in the economy and that other people are pulling back on that marketing spend that Meta is used to, capitalizing on.
And this is also a company, Kurt, as you know, that has had a great deal of regulatory and legal issues hanging over its head, completely unrelated to some of its pivot into the metaverse here. How much of a factor is that going to be for investors in 2023?
Yeah, I mean, there's two major issues here. One would be the dagger version of regulation, which is, hey, you have to spin off Instagram or you have to spin off WhatsApp or something like that. I think that feels dramatic. Obviously, it's a possibility with this FTC antitrust related stuff that they're dealing with, but I think that's probably not going to happen in 2023. I think maybe something more likely, and we've been waiting and talking about this for years now, is that they might try to regulate the data collection that Facebook can do, right? Some of the targeting that they might be able to do with their advertising business. Now, we've already seen how important that can be, right? We've seen the changes that Apple made to iOS last year and how that's really hampered Facebook and Meta's advertising. If that became a standard across the country with U.S. regulators, I think that could be a real threat to the immediate business for Meta as well.
All right, Kurt, so a lot coming at Meta, no doubt about it. If you look at the Wall Street community, I mean, the majority still have buys on this name, so they're optimistic about it. What are you hearing? What's the conversation about Meta for 2023?
Well, look, if you are investing in Meta right now, I think you're doing so because you believe in Mark Zuckerberg, right? This is somebody who time and again has taken gambles and he has paid off. If you are an investor in Meta, he has been right. And so if you believe that the metaverse and his vision for the future is a real thing, you're probably getting Meta for a steal right now, right? I think the issue is there's a lot of people who wonder, is this the company, is this the person that should be, bringing us into this new version of the internet? And I think that's where you're getting the hesitancy from people.
Is this new, Tim?
Well, the metaverse?
I mean, or at least what he calls the metaverse.
I think a lot of people take issue with that he's the one who wants to own the metaverse because there are a lot of companies out there that are trying to explore this. I mean, I go back to, the Nintendo Wii just like years ago and thinking about being able to, have a digital representation of my own avatar on a screen, kind of feels like what we're seeing in terms of examples that Mark Zuckerberg is giving right now. But it brings me to my question about making money doing this. Hardware is hard, we've heard a lot of people say that. Selling ads in the past has been pretty easy and highly profitable for Meta. How do they make money in the metaverse after making all this investment? Like, what is the ultimate game plan here?
Advertising.
Yeah, I don't think it's hardware. I think it's a version of advertising, and I think it's a lot more commerce, right? This idea that once you are truly living or working in this digital world, that you're going to buy digital things to, fulfill your life, right? Some of those might be as simple as upgrades on the technology, but like imagine here I am, maybe I want to be wearing a 3-piece suit in our interview, right? And then maybe I could buy that in the metaverse.
We like you the way you are, okay?
Kurt, I just want to know, do we have legs?
I need a wardrobe budget. Come on, guys.
Kurt, do we have legs in the metaverse?
We do now. I don't know if you remember, but at the October event, the legs were unveiled, so there are legs now in the metaverse.
Can you feel?
That means you will need pants
feel my eyes rolling
as part of that suit.
Now?
Oh, stop!
The good thing is you can play ping pong with like your deceased.
Did you ever think you would be like carrying around a phone and being able? Did you ever think? Look at your phone. Like you do everything on your phone. Did you ever think that you would be so tied to a phone, a mobile phone, where you could pay for bills. Why are you looking at me like I'm crazy?
Who's tied to a mobile phone?
I'm just saying that the
I'm
metaverse,
not.
it's possible. You are tied to
sure.
your phone. Come on. Come on, man.
I'm going to set up a spades game. It's like
All right,
me,
Bloomberg.
Malcolm, Martin, and Black Jesus.
We're going to bring Romaine into the future, we promise. Bow ties and all. They have that in the metaverse. All right, Kurt Wagner, thank you so much. Let's get on to another torch stock that is highlighted in this story. Coinbase.
Coinbase.
He's going to roll his eyes on this one, too. Let's bring in Bloomberg's Hannah Miller. She covers
this one out.
digital currencies and venture capital for us, venture capital for us here, metaverse or in the real world. All right, Hannah, so Coinbase, not a good year.
No, not a good year at all. We know that CEO Brian Armstrong said that revenue could fall by half or more this year compared to last year. So, yeah, it's been a rough time.
Rough to say the least. How do we think about 2023? Because, I mean, Coinbase just got absolutely destroyed this year, down 86% so far this year. And I think the question is, you know, in terms of crypto, it's a fundamental shift in the way that investors are thinking about it, or is it not? Because in an environment where, you know, one of the biggest crypto exchanges is taken out, I'm talking FTX here, Coinbase should be in a pretty good position to capture some of what was happening on FTX, right?
Yeah, I mean, 2023 could pose an opportunity for Coinbase. You know, they could argue, hey, we're a publicly traded company. We are a regulated exchange. What happened with FTX is not going to happen here. And that could help entice customers over. But the thing is, can they convince people that crypto is actually safe and good to trade?
Right, but if you think crypto is safe and good to trade, why not just buy the crypto itself? Why go through a proxy like a Coinbase?
Yeah, so that has advocates of crypto arguing that DeFi should be the way to go, that decentralized finance, where using peer-to-peer transactions is the way to go versus going through a centralized entity like Coinbase.
Well, that's what I keep thinking about, and I think we maybe have discussed this with you before, Hannah. I do think about coming off of, 1999, 2000 internet, right? The companies that ultimately really became the big players are different than some of the names that were floating around there. Do you feel like we get kind of an overhaul completely of the big names in the crypto space?
Yeah, I do think there's opportunity for a reset here. You know, there obviously is a lot of scrutiny on major players within the industry. I'm thinking Binance US here. And, Coinbase, we'll have to see. It's got to hold on right now. And, will people come over? That's the big question.
And I want to broaden this out and talk about crypto more in general, moving beyond just Coinbase here and thinking about what we saw throughout the year with the collapse of Three Arrows and then the contagion caused by that, and then the collapse of FTX and the contagion caused by that. What's the next shoe to drop when it comes to contagion from FTX and its downfall?
Yeah, so we're still learning a lot about what happened with FTX. We still are waiting to learn who the top creditors were here. And we know there will probably be some big names among that, and that could be an indicator as the bankruptcy proceedings move forward as to who had the biggest exposure. And I could say the same for BlockFi, too. That's a crypto lender that filed for bankruptcy in the wake of FTX's collapse, and we're also still learning more about who their creditors were.
Is the appetite, I mean, we talk about sort of the shakeout, not only from FTX, but of course some of the failures that we had earlier in the year here, and the idea that it shook out, I guess, the less than crypto faithful, if you will, but more importantly, a lot of folks who were probably more traditional finance folks, more institutional folks, and to that point, relatively new into this. Like a lot of these folks entered into this market just a few months before these collapses started happening.
Yeah, no, I think that's giving, people who entered this industry recently, it's giving them pause. Did we make the right call? Did the institutions who decided to finally bet on blockchain actually put their foot in it? We don't know. Based on what we have right now, it's not looking good.
All right, Hannah Miller covering all of this for us. I'll talk about Coinbase and a broader story on the Bloomberg terminal today about, I guess, some of the more disappointing stock performances of the year. That includes Carvana. Target was, that was such a disappointment.
I thought that was a surprise,
because I think everybody.
That was kind of an outlier in the list of things.
Yeah, absolutely.
But, at least the CEO is kind of owning up to it, and maybe he can sort of right that ship. But a lot going on in 2023 ahead. And we talk about 2022. This is going to go down as probably one of the most volatile years that we've had for the markets. The big question is that volatility going to remain in 2023 at these elevated levels? We're going to discuss that coming after the break. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A pretty sizable rally on our hands here in U.S. equity markets. Volume, of course, we should note, remains light here. Nevertheless, I'm sure some folks will take it. A 1.7% gain on the S&P 500, coming off what was roughly a 1.7% decline over the previous 2 days. So basically back to net zero here, at least on a weekly basis. A holiday shortened week here because of the Christmas holiday. NASDAQ up about 2.6% here on the day. And you talk about some of the individual movers. Basically, everything is higher today. But I think more notably is that some of the companies that I think that really kind of maybe got thrown out with the bathwater, if you will, getting bid back up. Disney up 3 or 4% on the day. Apple up about 3%. Southwest Airlines also up about 3.5%. In fact, we just had some news crossing the wire a little while ago with Southwest updating folks saying that they're starting to get conditions back under control. And remember, I thought this was interesting. Yeah, Beyond Meat rallying 11% on the day. No idea why. And then SVB Financial, which of course has a lot of links to the crypto world, also rallying hard today, up 9%.
Beyond Meat, down 80% this year.
Yeah.
Right.
What's and the concerns
40% of the float is shorted right now.
Yeah.
Interesting.
Well, that might have something to do with it.
Okay.
Yeah.
In terms of some of the short covering.
Well, anyway, so we talk about sort of what the setup is going to be for next year. I think the general consensus is maybe a little bit of pain at the start of the year, but a lot of people do see, at least for financial markets, a lot more healthy conditions going forward. Maybe not necessarily the economy. We did catch up with Ed Yardeni a little bit earlier today here on Bloomberg Television. Listen to what he had to say about his expectations.
The financial system is a lot more resilient. The banking system is in very good shape. For a lot of these bank executives have been saying a recession's coming, and yet their loan portfolio continues to grow, and they really aren't setting that much aside for loan losses. So looking at their balance sheets, there's sort of a contradiction between what they're actually doing, which is lending money and not provisioning for losses, and what they're saying. So I think the banking system's in good shape. The consumer's actually in good shape, with obviously some concerns about some credit quality issues in the auto market, for example. But all in all, wages are likely to rise faster than prices in 2023. And so I think the purchasing power is going to be there for consumers. And as we all know, the labor market remains strong and will likely remain so.
Well, to that point, Ed, if you have a consumer that is going to be able to keep up consuming and spending, and in theory, fueling inflation, are all of these things good because they raise the prospect or maybe the probability of a soft landing, or are they bad because if the economy holds up too well, the Federal Reserve is not going to be able to do its job?
Yeah, honestly, that's the sort of problem that bulls are having right now, is they almost can't win. If you get an economy that's too strong and belies the idea of a recession, well, then the Fed's going to have to raise interest rates a lot more. The key is that kind of narrow path where inflation comes down quite a bit more than is widely expected. That's the camp I'm in. We're seeing used car prices continue to plunge. We're seeing actual rent inflation coming down rather dramatically. We've seen energy prices moderate quite a bit. I think we're going to see 3 to 4% headline inflation on the consumption deflator this year. And I think it's going to happen pretty early in the year and ease some of the concerns about inflation. As you know, all these price indexes that are coming from the regional business surveys are continuing to show moderation.
Well, if we're talking about some of those inflationary pressures coming down, therefore cost pressures coming down, input cost pressures for companies, and consumer demand that is still holding up fairly well, is there too much doom and gloom about the earnings story next year?
Well, we're all debating soft landing versus hard landing. I think there's look, I'm realistic here. I mean, I'm not going to tell you there's no risk of a recession. I think there's a 40% risk of a hard landing and a 60% likelihood of a soft landing. The markets seem to be kind of flipped the other way, where they're more concerned about a higher probability of a recession. But nobody's talking about no landing. I mean, the reality is the second half of the year, after some weakness in the first half, has shown growth rates of 2 to 3% in real GDP, with the consumer spending, with capital spending holding up pretty well. It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers, and it may roll through some of the other sectors in the economy. But altogether, the economy is holding up. There's really no landings so far in the economy.
All right, that, of course, is Ed Yardeni of Yardeni Research, earlier on Bloomberg Surveillance, talking with our Kaylee Lyons. All right, we're going to stick with the markets now that we've got some real thoughts in terms of the economy. We've talked with several voices. You just heard from Ed Yardeni. Right now, we've got another voice when it comes to the equity trade and the investment trade. David Bahnsen is with us. He's Chief Investment Officer for the Bahnsen Group, and he joins us via Skype. David, nice to have you here. We've got a rally, Santa Claus rally for a day, perhaps. We'll see what happens tomorrow. When you look at the environment, can you really get a good feel of what 2023 holds for us?
I don't think in the very short term you can. It's not so much a trader's market. I think there's a lot of volatility, back and forth aspects that are more technical and much more unpredictable. Into a more intermediate term time horizon, I do believe people at least know what the questions are that need to be answered. I don't believe that the inflation story is one of great mystery. I don't believe inflation is created, first of all, by economic growth, by too many people having jobs, or by the consumer having too much optimism. Inflation is created by there being too much money supply relative to goods and services. And the production side, the supply side of the economy, has picked up dramatically. It was woefully unprepared for the COVID reopening, and we've fought through that for about a year and a half, 2 years now. But I agree very much with what Ed Yardeni said earlier. I think that the inflation aspect is going to surprise to the downside, and yet the valuations of high growth stocks remain too high historically to put a lot of optimism in indexes or the growth side, the FANG story. Therefore, we remain value investors and cash flow investors, heavy on the dividend aspect of the market.
Okay, we'll get to some of those picks in just a minute. First, though, I want to hear more about what you're thinking in the context of the Fed. If we do indeed see an inflation surprise to the downside in 2023, does that mean the Fed actually can cut rates?
Well, at some point they will, and I don't think it's particularly important. I don't think it's particularly important if they cut in Q3 versus Q4. At some point, the question is the terminal rate, not when cutting begins. And I think that terminal rate is 5% soaking wet, maybe 4.75. In other words, we're 1 or 2 more small hikes away from reaching it. And the issue the Fed has to deal with now is more messaging. How do they explain, with an inflation rate coming down, why they got so tight? And I don't think they can say what I believe, which is that asset prices were too high. They had overinflated housing. The broad inflation narrative gave them cover to really over-tighten. But we're also, let's not forget, as we talk about interest rates, going to have to deal with this balance sheet side as well. They've gotten a whopping $400 billion off of their $9 trillion balance sheet. So quantitative tightening is going to be something to watch next year as well.
Yeah, I'm surprised we haven't heard a lot more folks talking about that. I mean, if you get an acceleration in that, I mean, that pretty much is good for a few more rate hikes, at least on an effective basis. I am curious, David, if you just kind of give us a sense here, when you look at market pricing, and I know market pricing over the last couple of weeks is probably distorted by the lower volume, but I'm curious as to when we start talking about a terminal rate of 5, but you still have have rates for the most part under 3% on certain parts of the curve and well under 5% on the rest. And then you have an equity market that at least wants to rally here. What's the message that's being sent? I mean, what are investors betting on, even if they don't necessarily see the same reality as you?
Well, let's keep in mind that the Dow is a different story than the NASDAQ, for example. The NASDAQ right now has compounded at a grand total of 3% per year for 22 years. Okay, it's a stunning fact around its drawdown that it's experienced. I don't think that the large growth, high valuation, high beta side of the market is looking to rally. A lot of the darlings, the biggest cap companies, have really stubbornly refused to participate. And some of the great performers of the last couple of years have struggled even in the fourth quarter as most markets are up, Apple, Tesla, et cetera. I think it's more about a reversion to the mean, that you have value that was so disconnected from its normal relationship to growth that quality is just benefiting. And this is so similar to what we saw in 2000. Now, in 2001, 9/11 distorted a lot of this. We had a minor recession in 2002, but that's a story that I think doesn't get enough play. That you can have a recession, you can have a bear market, and still have some things in the market do well when other things are not. That's really what I expect going into 23.
But David, when you talk about some of these big tech stocks, is it fair to lump them all in one basket? You know, Apple being the same as Meta, being the same as, you know, Netflix. I mean, how do you differentiate? Because there's got to be some that are opportunities. Some of these names sell a lot of stuff and are highly profitable.
Right, all of them sell a lot of stuff, and all of them are profitable, but none of them are opportunities. And I agree 100%. They're not monolithic, and it's something I've said on this show before, and I've been saying for a couple of years. Even when they were all going up, they weren't all going up at the same pace. Now, this year, when you have the best performer down 30-ish and the worst performer down 70-ish, it's all pretty bad. But you're right, those are two pretty different numbers. I think that the profit outlook and the growth outlook is different for all of them. And what's unique is that, like with Meta, for example, it's a real fundamental problem. Where with Apple and Google, I think it was just a valuation problem. The problem is a growth catalyst. What is exactly going to give it a couple more turns in a PE ratio? I don't have the foggiest idea what would make Apple trade up 25% at this stage of the economy. In terms of technological innovation, there's nothing that's going to give it that kind of boost in 2023.
Given that we've seen a decline in some stocks that we traditionally classify as growth stocks, like a Netflix, like a Tesla, like a Meta Platforms, for example, we've seen price declines that perhaps show that there could be more value plays. Would you consider that a reason to get into some of these stocks, given that the price has declined so much that the metrics now show that they're value plays?
Again, we're
not saying Tesla by any means, by the way.
Yeah, that would be a great exception. But no, I like the idea of that, but in fact, they're not there yet. Now, what happened with Microsoft and Intel, where they became value plays out of the financial crisis? They were big dividend payers. They had 5% dividend yields back in 2009. None of these companies we're talking about, with the slight exception of Apple, pay any dividend at all. I do think they're much lower, but they're not valuations yet. Looking at the free cash flow yields, for example, there's still a ways to go. I'd love for that to happen. And a lot of those old companies that were big growth stories in the 90s, Cisco, Qualcomm, Intel, became value plays later on and ended up getting a lot of great performance out of that value level. But the FANG story is far from being there.
It's far from being there. Let's talk about, I guess, maybe what could potentially be those next growth stocks. There were a lot of folks betting, whether it was on, I guess, bets that didn't pay off, you know, like the Pelotons of the world. Others like Tesla and others seem to have maybe shown a little bit more hope and promise. Where do you see it?
Yeah, I think that Tesla has always had to rationalize its valuation on being more than a car company, but being a platform around future battery utility. And you have just a very mixed bag with the CEO. A lot of people love him, a lot of people hate him. I don't ever love the idea of someone who oversees a company worth hundreds of billions of dollars having a second job or a third job or a fourth job. Now, in fairness to him, he's done it for years. I mean, even before Twitter, he had SpaceX and these other issues. but it's just not something we can get excited about without the free cash flow generation that we want to see. But if one forced me to pick which of these growth names that has gotten hammered of a big capitalization, I think has the most upside opportunity, it would be Tesla. The other types of categories, you mentioned Peloton and some of those work from home stocks. Prior to the break, you guys were talking about Beyond Meat. These are companies that hedge funds have to go pick after if maybe they can be a private equity takeout, because they have no chance of ever making real big boy money to be a major publicly traded company. Beyond Meat is down 80, 90%, and it could go to zero. But a private equity company will take it out before it goes there. Those just aren't the things we look at and what we're doing.
All right, private equity in 2023 is a completely different conversation, but one we'll certainly have in the coming days. David Bahnsen, Chief Investment Officer at the Bahnsen Group, thanks so much for taking the time and joining us this afternoon. Really appreciate it. Well, coming up, we're talking about some of the big losers of this year. They're actually leading the Santa rally. Romaine mentioned a couple of them a little earlier in the program. We talk more about those right after the break. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I'm Madison Mills. Here is First Word News. Democrats plan to release former President Donald Trump's tax returns, which may start a tit-for-tat battle. According to a Republican aide, this could start a trend of using IRS documents to target political foes. Republicans, who will take charge of the House Ways and Means Committee, may retaliate by publishing the tax records of Democrats. The anonymous aide argued the Democrats may end up regretting this move. And the Housing Works Cannabis Company will open New York State's first legal retail weed shop in Greenwich Village. This morning, leadership offered remarks on the historic opening.
Legalization for us has never been about just freeing the plant. Recognized really early the intersectionality of this issue, the way that we could use this fight to uplift other fights, other voices.
The preference for justice-involved individuals is a defining feature of New York's legal cannabis regime. The first 36 license holders all having some connection to previous criminal prosecution for illegal marijuana sales. And thousands of stranded flyers in the U.S. who are booked on Southwest Airlines might be finally getting some relief soon. The airline plans to return to a normal schedule on Friday after a week-long meltdown that stranded thousands of passengers. CEO Bob Jordan said that the actions taken to restore its network are working. The carrier has been operating a significantly reduced schedule for several days while it recovered from disruptions caused by those severe storms and overwhelmed scheduling technology as well. And in Italy, authorities didn't find any new COVID variants among recent arrivals from China, those who were testing positive for the virus while in transit. That's a relief for officials worried about fresh health threats. Both Italy and the U.S. have joined an increasing number of nations demanding COVID tests for travelers from China. And Brazilian soccer legend Pelé has died at 82 years old. Pelé helped Brazil to 3 World Cup championships and was long regarded as the best player in the world's favorite sport. According to the Associated Press, he'd undergone treatment for cancer since 2021 and died at a hospital in Sao Paulo. His official Twitter account writing this afternoon, "Inspiration and love marked the journey of King Pelé, who peacefully passed away today." Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg.
All right, and welcome back to Bloomberg Markets to Close. Counting you down to the closing bells here. Just a little while to go. And a look back here at 2022 and the dismal performance of the S&P 500 on a year-to-date basis, down about 19% or so. But Abigail Doolittle tells us, well, there are a lot of bright spots underneath the hood there when you look at some of the individual names. Abigail joining us right now to walk us through this. All right, I know energy is at the top of the list. If you invested in Occidental and Chevron, Exxon, you made a fortune this year. Once you get past energy, where were you making money this year?
Well, you know, it's interesting, Romaine, because this year we've been so focused on the negative and stocks going down, obviously the worst year since 2008, that 19% decline. But when I did a sort earlier on the S&P 500, 175 stocks are higher. So to answer your question, it is energy. I do need to mention Occidental for a minute because it's more than a double. Like, who knew in 2022
I don't know,
a major
Warren
company?
Buffett? Did Warren Buffett know?
Maybe Warren Buffett is 20%. Yeah. But then the next big area, defense contractors, and that probably has something to do with the Russia-Ukraine war, but you have the likes of Lockheed Martin, Northwell, you know, those stocks higher. And then the consumer staples. You have General Mills, you have Kraft Heinz, Kellogg, Deere, Caterpillar. All these stocks are at more than 20%. How, as the media, and how have I missed this all year? I mean, I was vaguely aware of the defense contractors, but there's just been so much fear and so many declines that that's the story as opposed to these winners.
But still, when I go through all these names at the top, at least, you know, you go through the top 20, 30, they all seem very defensive in nature.
They are very defensive for sure. I mean, these are items that folks need. I mean, going beyond the defense contractors and, you know, and oil, another piece of that could, of course, be, you know, the war in Ukraine. You know, actually, I have an interesting one to pop in with because I'm just looking at my notes here. So this is going to cause a little controversy maybe. But, and it's not Tesla. The other side of Tesla, because of course Tesla right now is down 65% on the year, but Twitter, before going private, up 24% on the year.
What's it trading at today?
Well, it's actually in the list. It's in our year-to-date list. So if you do an active sort on the S&P 500, it's in there.
I did read an article.
It's shown as like, but they show the stocks to their year-to-date performance until they went out. So when was that? October 30th or something like that. So
I did read an article in the last couple of weeks, Romaine. If you're still interested in getting in on the $54.20 per share, Elon Musk is still accepting money. So he's accepting money. So
me too.
Money winners.
Aren't we all? The idea of these you know, consumer staples really being at the top of the list is a little concerning, I think, for people because, you know, in a down market, you're still going to go out and buy those things, right? Canned soup, for example, with Campbell's, you're still going to eat cereal, Kellogg, for example. What does that tell us about the way that investors are thinking about 2023?
Well, good question. And I would argue something is going on for those companies that goes beyond the fact that they're staples and there's items that you need, but there's also good management there because a lot of these companies, they've managed the bottom line really well. They've managed margins. They've managed to pass along higher costs to consumers who have paid them. Now, another reason this group is higher, similar to the utilities, the dividends there. So it's interesting. Usually dividend stocks are going to do poorly when yields are going higher, but in this case, because of that defense, folks want whatever money they can get.
Can we end on a down note here? Because because you started
Yes,
off.
let's end on a down
this
note, just for
idea.
you, Romaine.
It's something like, almost a third of the S&P somehow is rallied this year, despite the index being down 19%. But more than a third of the index, of the individual members, are down more than 20%.
That's a stat that I actually wasn't aware of, and I'm looking at a screen. I know. I'm guessing that it is. I'm looking. I'm looking at the screen right now, and it is pretty amazing because you have the likes of some of the names that you all were just talking about: Tesla, PayPal, Netflix, Amazon, Expedia, Nvidia, Intel, all down closer to 50%. I mean, those are incredible.
And like some of those you make sense. I mean, some of those make sense. Like Nvidia, Tesla, you understand there were growth stories. Like the bloom came off the rose. But then when you see names like GM, FedEx, down 30% here on a year-to-date basis.
Well, FedEx has had some problems. I mean, they were through their outlook.
Delivering packages?
They have not, but they did
Disney down
from a stock perspective. Well, Disney has had some significant issues.
Have you been to Walt Disney World lately?
Okay, Romaine, I'm about to reveal a secret. I've never been to Disney World, and I'm dying to go. I've never been in a Tesla, and I've never been to. I've been dying to go for years.
All right, we got to run.
Group trip.
We got to run. Okay, so Disneyland for Abigail in 2023. All right, Abigail Doolittle with some of the names and what they did this year.
Have you been to like Six Flags or Great America or anything? No,
not
you're not an amusement park?
Not my thing.
You're not into amusement?
Not my thing. I like flying.
All right, to be continued. Right now we want to talk about the year that was tumultuous for many of the world's richest people. Maybe we should play this world's smallest violin here. According to the Bloomberg Billionaires Index, let me put it out for you, almost $1.4 trillion was erased from the fortunes of the richest. When you take a look at some of the richest individuals that are out there. Devin Pendleton of Bloomberg covers this for us and takes us through some of those who are atop this list. So Devin, tell us, at the top, we know this was a rough year. I mean, certainly for many of these billionaires who their wealth was in, maybe their share prices, it was pretty tough for them. Who's at the top of this list?
Top of the list, not the top. You don't want to be at the top of this list, but the top of it is Elon Musk. You were just talking about Tesla and Twitter. Yeah, it's inevitable. He's had a really bad year. Of course, Tesla's been down a whole lot, and that's partly because of the tech industry having a really rough year, but he didn't help it probably by buying Twitter and having to sell Tesla shares, having to leverage Tesla shares, having to pony up a whole bunch of cash. So he had a horrible year. That's on dollar terms. He's down $138 billion.
Yeah. Who else? Yeah, we should point out he's still a billionaire, right?
Oh, yeah. He's still a billionaire. He's still the second richest person in the world.
Who else? Who else got hit?
So Mark Zuckerberg, of course, had a terrible year. Meta, it was down dramatically this year. I mean, he has lost 65% of his fortune. He's now 25th richest in the world, which does, bring out those tiny violins. It doesn't sound bad at all. But you have to keep in mind, he's been in like the top 5, top 10 consistently for the past 7 or so years.
Go ahead. No, you go.
There's one name on this list where it's like completely self-inflicted among them. SBF, Sam Bankman-Fried, a really pretty stellar fall from grace.
Yeah, I mean, SBF was kind of like the exclamation point on this year, I think. Like, it had been a bad year, and then that came along and imploded. At his highest, he was worth $26 billion. Wow. But the week that FTX imploded, at the beginning of that week, he was worth $16 billion. That vanished in less than a week. I mean, that was historic.
Great reporting, Devin. I'm going to have to leave it there. And actually, if you have a Bloomberg terminal, you can just type in Rich Go and sort it for yourself here. $138 billion in wealth with regards to Elon Musk in terms of the change we're talking about. Jeff Bezos up on that list as well at the top. Mark Zuckerberg, Larry Page, Sergey Brin. But when we talk about the tiny violins, we should point out all those people still billionaires.
All right, coming up, we're going to talk more on the stock rally.
Are you a billionaire?
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
In Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Welcome back to Bloomberg Markets. The close, the clapping, the bell ringing, taking place here on this Thursday afternoon in New York. An unseasonably warm day, and well, I guess somewhat unseasonably warm sentiment. I don't go outside anymore.
It's dangerous up to 50 degrees today.
1% right now on the Dow Jones Industrial Average. That's higher by 345 points, Carol
Impressive.
Nasser. Yeah, I give it to you in points. 66 points on the S&P 500. A gain of about 1.7%, basically recouping all of the losses from the previous 2 days, while the NASDAQ composite is going to finish the day higher by roughly about 2.5% here. We should point out pretty much everybody got in on the party today. All 11 sectors were higher here on the day. Pretty much every stock out there, with the exception of maybe about 26, 27 of them, finish higher in the S&P 500. I don't know if this is a real conviction behind this, or really just a lot of people at the end of the year here seeing an opportunity to pick up a few bargains.
Yes, yes, and yes. And I also do wonder how much, as the market started to move higher, how much was short covering of some names that have been just oversold or highly shorted at this point.
Yeah.
Maybe. It's also a thin market.
It is, yeah, and yeah, thank you. And we always need to kind of put that asterisk every day this week here, that volume is incredibly light, as it typically is this time. So I don't know how much you can read into the price action or extrapolate.
I feel like at some point you're going to dismiss this.
I can extrapolate one thing.
What?
It's still going to be a brutal year. One more trading day for the year.
What year? 2022?
2022.
Well,
I mean, we're down.
That's a bold call.
Yeah, 19.6% on the S&P.
A 40% rally over the
down
next
more than 33%.
Tim going out on a ledge on this one.
The NASDAQ. Hey, when you're right, you're right. What can I say? When you're right, you're right.
Carson, what do you do? The great on the great. Magnificent. What was the guy?
Karnak, wasn't it?
Karnak. Thank you.
Thank you very much.
I don't know what you guys are talking about.
That's right.
All right.
We are
Can we talk about so Tesla, the #1 gainer in the Nasdaq 100, the #2 gainer in the S&P 500 today, up more than 8% in today's session. Yeah. I mean, pretty amazing. It's had a 2-day bounce. So investors, as you talk about, Romain, some of the investors coming in. I mean, at some point, Kathy Woodwin has been buying in a big way. I do wonder at some point, if you believe fundamentally still in this story, do you say, man, this stock is on sale in a big way?
Well, obviously, yeah. I mean, and look, I mean, we've talked a lot about the big shakeout that we had earlier this year, not you and I, but on Bloomberg Television. And this idea.
You and I don't talk off air.
Right. And this idea, no, never. But the idea here, though, that there are obviously a lot of Tesla faithful, and not just faithful to Tesla, but really faithful in that growth story about EVs, about batteries. And if you believed in that growth story a year ago, why wouldn't you believe it now?
Because now you have Ford with the F-150 Lightning, you have the Ford Mustang, you know, Mach-E that's able to be shipped now. You have Volkswagen working on these cars. I think that's the big story now, and maybe people are thinking about Tesla more as a car company than less of an energy company.
You know, it pains me to give any compliment to Elon Musk, but I do think that one distinction, and it's something that I think Adam Jonas, a lot of folks bring up, is really the battery technology and some of the software gains that he made there that are really the differentiator between that and the F-150, between that and GM's vehicles as well.
Let me just say something about electric vehicles. Yes, more competition's coming out, but we had a Bloomberg story earlier in the year that talked about the tipping point when it comes to EVs, and once 5% of new car sales go fully electric, and they did some analysis of 19 countries. You know, we've seen a lot of countries do that EV pivot, so that even if there's more competition for Elon Musk, there's still going to be more people increasingly buying electric
I know we
vehicles.
got a lot more to cover, but did you see, I think it was earlier this week or maybe last week, when the head of Toyota came out, and he was asked specifically why they're so behind in the EV race. He kind of made the point here, they're more interested in hybrids, they're more interested in hydrogen, and he made the point that the future of alternative fuel vehicles, non-combustion vehicles, actually isn't going to be electric, and a big part of the reason is, he said, is sourcing the materials. Look, he said, look, you know, Elon got out there out in front of people, that's why he's able to do a lot of these things with the lithium, the cobalt, and things like that. But Toyota sees the writing on the wall. They can't get that at scale, and maybe they have to find another energy source.
He sounds like my husband. My husband won't buy a car until it's hydrogen or hydrocell. No, it's hydrogen cell. Yeah, I mean, he thinks that makes much more sense in terms of the environment. I mean, there's a lot of things that we're still figuring out. Don't tell him he's right. I'm just going to hear it forever and ever. All right.
Mr. Masser, you are always right.
Southwest Airlines also up almost 4%. Man, we've been talking about this all week. We know the story. You know this story, but nonetheless, investors coming in. And it looks like Southwest is finally coming out and saying, you know, that we think we're going to have some normal flying schedules tomorrow. So that should be a good thing. Cross our fingers for everybody trying to get somewhere. Netflix, this was also top among the major averages. Former bear turning to a bull. I always love this. Ken Leon coming in from CFRA, upgrading, raised to buy from sell. Talk about a swing, though. It's not like getting lukewarm about it. He talks about their best-in-class platform. I mean, price target raised from 310, raised to 310 from 225. What did the stock close at? 291, so a little bit of room for movement. And then China names. I continue to watch them. I'm going to watch them. I'm going to talk about them a lot in 2023. This index has been on a tear from late October, up another 2.7% today. So, all right. Tim, do you have any decline?
I do. Yeah, I should have some decliners. Traditional names that have actually done pretty well this year, including those names like Campbell's Soup and Cardinal Health, getting a little bit of selling today, down 0.6% on Campbell's Soup. Actually had a 52-week high yesterday. Shares up 30% so far this year. Cardinal Health shares up 50% this year, down 1% today. This is, I think, one of the most interesting decliners of the day. It's Cal-Maine Foods, the biggest maker of shelled eggs here in the United States, biggest seller of shelled eggs here in the U.S., down 14.5%, its worst day since 2008. The company reported earnings yesterday, said that they missed expectations. Analysts essentially said that because feed cost inflation could be hitting the bottom line, and also a surge in egg prices could have peaked. So we could start to see those egg prices come down. Not good for the company's bottom line. That thanks to a lack of avian flu of late. Yeah, MicroStrategy down 1%. I had to throw that one in there.
All right, well, that's the read here on some of the individual movers on the day. The broader equity markets as well. We should point out the activity in the debt markets was relatively subdued. You did see some buying here with yields pushing down by about 2 to 5 basis points across the curve.
Don't you find that interesting that once again we're seeing like the bond and stock market kind of correlation.
Yeah, and that's going to be was a big part of the story earlier in the year before that finally split, and a lot of people think that could be a big part of the story going forward. Let's keep this conversation going and bring in Michael Kelly. He's standing by right now. He's a global head of multi-asset over at Pine Bridge Investments. Let's start off, Michael. First of all, thank you for being here, but let's start off with a look ahead rather than a look back. Optimistic, pessimistic, what?
We have to be patient, still cautious. You know, everybody says that everybody's cautious, but if you look at the caution built into markets, risk premiums, equity risk premium is below normal, credit spreads are below normal. And on the slightest good data point, like today, continuing claims, you know, they show the first sign, the first inch in a 100-yard run, the markets are off and running. So, you know, people are still programmed for the last 40 years of disinflation, where expansions were longer, recessions shorter, downdrafts shallower. Inflation is different. So, you know, it's just the opposite. So expansion shorter. Look, this one was only 2-3 years expanding. The recession will be longer than people think, we think, and the downdraft deeper. So still cautious.
Yeah. Well, you know, Michael, though, even in tough times, right, there's always investment opportunities. So I am curious where you are finding opportunities at this point, putting new money to work.
Well, you just mentioned one, which is the Hang Seng China Enterprise Index. You know, that now, after the rebound you just mentioned, is down in line with other markets after massively underperforming, you know, for the prior 5 years. And the asymmetry to what's happening there, they put themselves into a recession in 2021 with a lot of policy crackdowns. They compounded that with COVID-0 in 2022. And now all those things are being lifted at once. You know, it's a battleship that's turning very, very fast up while we're waiting and waiting and waiting for things to begin coming down. So, you know, that's something that we would look for kind of in the equity market, the treasury market, longer treasuries. You just mentioned, yes, they are still synchronized. And you see, you know, the soft survey data starting to come down pretty hard. It usually leads the hard data, but the hard data is still creeping up. And it's a very long divergence at the moment. When they start to converge, you'll start to see the stock market and the bond market de-link with longer treasuries kind of leading the way. So those would be two places where we think you can make good money next year in a rough year to make money still.
Michael, I'm interested in your thoughts on the energy transition. I know in the comments that you sent to our producers earlier today, you said that Putin's invasion of Ukraine certainly pulled forward the energy transition, but I would argue that we're kind of seeing how slow that energy transition takes, that coming into sharp relief this year for, I think, many people.
Yes.
And just look at what happened just in the last week or so with cold weather throughout the country and the reliance that we have on fossil fuels to heat our homes and power our homes, and how fragile that grid is. Where are we in the energy transition, and where are the opportunities in 2023 and beyond to take part in that transition?
The energy infrastructure is probably one of the largest infrastructures in the world. Rebuilding it is going to take a long time. That's actually a good thing if you're an investor in something with a long tail of growth. But what a year we've had, right? We actually had the first successful fusion, no nuclear waste, fusion test, solar, wind power, you know, hydrogen, all these things just have long, long tails to them. And they've been supercharged. You know, when you look at what Germany was doing, they had shut down, you know, 2/3 of their coal and 3/4 of their oil, having only replaced 1/3 of that with kind of new energy. That's why the natural gas price in Germany was up 300% before the invasion. These things have to be paced. They do take a while to get on stream, but that's why you want to get on board, because there's a long tail of accelerating growth in this space, and we think it's one of the really great places to be for the next 5-10 years.
When we talk about long tail and long tail opportunities, talk to us about China and the role that it's going to play for investors here in the U.S.
Well, it's a constructive role, you know, at the moment, in the sense that in 2021, 2022, when the world was overheating, they were putting a lot of policy crackdowns on their economy. Inflation would have been that much worse had they not been doing that. And we're going to be gradually losing steam as the year goes on. It's not a bad thing to have them providing a counterbalance to that. So I'd say that's one thing that you can look forward to. While Japan is sort of giving up on being the last big central bank in the world that's still in rapid easing mode, they made the first baby step there. with their widening of bands around yield curve control.
Michael,
go ahead, Carol.
One thing I do wonder, because you can invest anywhere, and I was looking at the MSCI World Index. I mean, it's down about 19% so far, and developing kind of a similar decline. If you had to pick one or two markets that you think investors should really think about investing in 2023, do you have a good feel on that at this point?
Yes. So we don't think the U.S. will necessarily be a leader, although you can buy long duration growth stocks like solid technology stocks, not super high flyers still. But China will be the best performing big market in the world. When you come to bond markets, you want to look at U.S. Treasuries, but China property bonds, the higher quality ones, will actually be up much more than most equity markets. They've already had a big run. When you look into the commodity markets, a lot of the green metals, lithium, cobalt, copper, aluminum, they have a very good prospect with China opening and with this wave of green energy spending being pulled forward of going up. Currency-wise, the yen could have probably one of the better years around the world. So those would be some of the areas we would point to.
All right, Michael Kelly, we're going to have to leave it there. Michael Kelly, Global Head of Multi-Asset at PineBridge. Thanks so much for joining us. Really appreciate you taking the time this afternoon. Guys, we spent a lot of time talking about the public markets this afternoon. When we come back, we're going to dig into the private markets because 2022, guess what?
You're a big venture capitalist. You've been investing on the side here?
It's been a pretty bad year in terms of deployment for venture capital. Yeah, worst drop in over 2 decades, according to data from Preqin.
Yeah, it'll be interesting. I mean, I remember early this year, at the start of this year, I was out in LA talking with a lot of these folks, and they were still optimistic, at least publicly.
Yeah.
They were basically saying, don't worry, we don't have to mark the market the way public
Well, SPACs were a big
guys
deal,
do.
right?
And of course, we know behind the scenes, things were a lot messier, and we know that in hindsight.
There's a flip side to this too, though, which is this is the time, as Mark Andreessen would say, the time to build, where a lot of companies in down markets are built.
If you have the money, and more importantly, not just if you have the money, but if you can actually get the financing for it, and that's a big part of the equation.
It's a good thing we have a guest on venture capital coming up because we got a lot to talk about. You are listening and watching Bloomberg Markets.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All right, welcome back, everybody. You are listening and watching Bloomberg Business Week. Oh, actually, Bloomberg Markets. Excuse me. It's usually Business Week.
That's next week.
What's your show, Romaine?
Bloomberg Markets The Close, Carol.
That's right.
We're all here together.
All right, Carol Massar along with Romaine Bostic and Tim Stanovic.
I have that tattooed across my knuckle.
So Sorry about that. All right, let's turn now to, we're going to talk a little bit about venture capital, I believe, right?
Someone help Carol.
I know, sorry, I had my rundown closed. We are talking venture capital. Hopes are high for a better year. We know that the IPO market and underwriting for private firms, they took a big hit, certainly during the back half of 2022. It was a very difficult market environment. Nobody wanted to bring a company public. So we've got a great voice to talk about what might happen in 2023. Co-founder and managing partner of Left Lane Capital. We're talking about Jason Fiedler, and that, of course, is a New York-based venture capital firm. Little wacky on this Thursday, Jason, but good to have you here to help set us straight when it comes to VC. What are you anticipating in 2023?
Well, thank you for having me. 2023 is going to be quite different. I mean, 2022 was a heck of a year. It started off real hot out of the gate off the backs of 21. And then the second half, we heard crickets. I mean, there were, specifically speaking about the kind of multi-hundred million to low billion-dollar private valuations, firms, there were really 5 of them that were writing those checks, were pencils down. And now we're in this environment where no one wants to catch a falling knife. No one wants to price anything. And so it's been a big reset in the second half of the year. We're really excited about early 2023 as valuations right size. We're taking a lot of guidance from the public markets as eventually that's where things will be headed.
I am curious, though, about, I mean, we talk a lot about, obviously, the cuts in valuations and some concerns here about the health of these companies and whether they survive whatever sort of economic downturn we're in. There's also a lot of questions here about, Jason, about the idea that these are supposed to be longer-term investments. There was not necessarily expected to be short-term payoffs. Is there any sense here that the structure of how some of these companies were financed, and more importantly, how they were run, was built in a way that they can continue to, I guess, not necessarily thrive, but at least survive throughout this downturn and then maybe eventually get back to some of those valuations down the road?
I think what we're seeing is that the companies that were able to raise a lot of money off the backs of huge growth and a lot of, if everything goes right, they could be worth this much. Yeah. They're in trouble. Okay. They're in trouble. But the companies that we're backing that have underlying strong financial profiles, they're going to be in good shape. They can switch from growth at all costs to an efficient growth strategy, preserve the money that they have raised at the valuations that they have already. It's going to be the companies that are burning a lot of cash, don't have the opportunity to switch into that more sustainable growth mode, that are going to be back in market. And that's when the private investors smell blood, and they're going to come in pretty steep on valuations and terms.
Jason, you've invested in companies such as Calm, Trivago, Blank Street, HelloFresh, Masterworks, quite a few more. When you think about your portfolio companies, are you concerned about any of them going out of business in 2023?
Absolutely not. So Left Lane, we're a newer fund based in Brooklyn, New York. We've raised $2 billion over the last 3 years to invest in consumer internet businesses that develop long-term economic relationships with their customers and focus on core areas of wallet spend. So these are not the areas of spend that in a downturn, if a consumer cuts back 10, 20%, that they're going to be sacrificed. If rates go down, if a lot of the other macro environment stuff that you're talking about, this is how you take care of your health digitally, how you educate, how managing your wealth. So these are core areas, and we are absolutely not worried about any of our companies getting out the other side. As I've also said, we are always super disciplined in looking at those underlying economics. And these are businesses that are asset light, they have high margins, they don't have high burn rates, and they're able to stomach a lot of what's coming. And by the way, these are businesses that will do just as well in a downturn as an upturn. Talkiatry, for example, is an in-network mental health business. For $30, you can see a high-quality psychiatrist versus $200-300 you would spend as an alternative. So we have countless examples of businesses where, yes, they would do well in an up market, but they're going to be able to stomach what's coming ahead.
All right, so able to stomach what's coming ahead, Jason, but when you check in with the heads of your portfolio companies, what are they saying about the environment?
They are not yet seeing pullbacks on spend, and I think that's because of the categories that we are focused on, right? If you take one of our dog food companies, Pet Stable, for example, you're still going to feed your pet. Another company, Go Student, is a one-on-one tutoring platform. You may actually switch more into that type of education as it's efficient on cost. So the real thing that we're talking about with our founders is just this efficient growth. Really not having to rely on outside capital in the next 12 months, because that's where you're going to suffer a lot of dilution. And adverse selection, the companies, especially at the later stages that are out there raising, are generally the ones that don't have as sustainable or profitable business mechanics. As a result, also, we're focused on the even earlier stages of our practice. So we span Series A to Series C, which can be a big window of valuations from kind of 50 all the way up to $1 billion. We're very, very focused right now on that earlier part of our practice as a result.
All right, one more question for 2023 in terms of what you're seeing. Do you agree that this is now the time to be building? I made this comment before we went to break to Romain, and he did mention the difficulty in getting financing right now. Are we going to look back on 2022, 2023 as a time when some of the great companies of the next decade were born?
Absolutely. I mean, it reminds me a little bit of the beginning of COVID when we started our firm, when a lot of investors had deer in the headlights, and we made two of our best investments, a Go Student company I mentioned and another wealth management platform called M1. I think we're in a similar position here where the reset has set in. It took a while for founders to truly realize that they weren't exempt from what's going on in the macroeconomic environment, and they need to raise at sober valuations in order to make the next round work. And so we're excited about the beginning of 2023. I think there's a lot of innovation to be had. We're early in digital penetration of consumer categories across the $2 trillion of spend in the Western world. So we're very excited, and I think you'll see some big companies raising in the seed and Series A over beginning of 2023.
Jason Fiedler, Left Lane Capital co-founder and managing partner. Really appreciate you taking the time and joining us this afternoon. Well, now let's get back to the latest when it comes to FTX, when it comes to crypto. The latest allegation is that FTX used $200 million of customer funds to make 2 venture capital investments, this according to an SEC complaint. We're going to break down the regulatory implications now with Bloomberg's Hannah Miller. Hannah, you cover this so closely. So give us an update on what exactly this complaint says, and then what this could portend for regulation in 2023, because, I thought, these crypto companies are desperate for regulation. That's why they're all, based in the U.S., right?
Yeah. Well, with this, this detail in the complaint, FTX and Alameda were major venture capital investors in the crypto space, helping to prop up some big names within the industry in various sectors. So this, allegation that they used customer funds in venture capital investments is pretty startling. And it also allows the SEC to kind of really stake a flag here as they move towards further regulating the crypto industry.
So, where do we stand? We already know that the SEC has kind of beefed up its staff. We're still waiting for that legislation out of Congress to determine which agency should really sort of be the umbrella agency for crypto. But even before we got to FTX, you had so many names out there that fell under regulatory scrutiny for reasons that I think a lot of people said shouldn't have happened in the first place. The regulation should have already been there.
Yeah, no, I think that a lot of people within the industry, those who are criticizing bad players have said that, different people have taken advantage of this regulatory gap, that, companies have been allowed to step in and really rake in lots of money in what has been described as a wild west when it comes to crypto. So I think there are people who want greater regulation in order to kind of flush out bad players and kind of help add more legitimacy to the industry.
All right. Well, certainly another story for 2023 as you wait to see what the regulatory approach is and whether the crypto faithful can live with it. Hannah Miller covering all of this and quite a few things other for us here at Bloomberg. I think we're going to talk to her in the next block as well, too, right?
Yeah, looking forward to that.
Okay. All right. Thank you, Hannah. We'll see you in about 5 minutes.
All Hannah, all show.
A lot more coming up here on the show. Yachts. You ever rented a yacht?
I haven't. Well, maybe it's because it's not easy enough.
We're going to talk about that after the break. This is Bloomberg.
expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
President Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
Welcome back to Bloomberg Markets to Close. Tim Stenevec, along with Carol Masser and Romaine Bostic, on this Thursday afternoon of this shortened trading week. Shares of Southwest Airlines, ticker LUV, actually closing higher today for the first time this week. This after falling a combined 11% over the last 2 days. This as a result of the crisis that the company continues to face, though things are improving. For the latest now, we bring in Madison Mills. She's with us in the Bloomberg Interactive Brokers studio. Maddie, is the worst behind us, or worst behind it for Southwest Airlines?
They certainly hope so. Southwest canceled over 2,300 flights today, but so far only 39 flights canceled for tomorrow. And we did just hear from Southwest CEO, if you look on your terminal there. And for our listeners, I'll just tell you about it. The CEO saying it's too early to estimate the cost of network disruptions, and commenting in a media briefing saying that Southwest is going to reassess tech modernization plans in the wake of this crisis, but that this re-upgrading of their tech system is going to be a multi-year process. So short-term, things are looking okay heading into Friday with those lower flight cancellations. But again, we're hearing from the CEO that that tech modernization plan in the wake of this crisis is going to be ongoing. That's going to take a lot of time and a lot of investment in the years to come.
Well, and it's kind of interesting. I do wonder about this CEO kind of coming out and saying this tech modernization. It's not a new story, right? This is something that he's been working on with his team.
Exactly. And even though he's only been in the top job for 10 months, he's been at the company for a long time.
Right.
But we are hearing also, we have a great report from our colleagues who are doing their best work covering this. They talk to communications and crisis managers who say that this is going to blow over, that in the first quarter of 2023, we're going to see some issues, but that Bob Jordan's actually doing a good job apologizing.
You guys have talked about this for the past couple of days when I brought this up. You know, people have a short memory when it comes to this type of stuff. And, you know, if they're loyal to an airline or they shop based on price.
Right, or on price. If they just cut their fares for the next few months, I think they'll be okay. In all seriousness, though, I mean, there's a sort of a process, and one of the headlines that we heard out of Jordan is the idea that this is going to be a multi-year process to upgrade these IT systems. Of course, a process that a lot of people think should have started several years ago here. Give us a sense as to what we know, as to what they have to do, and why it would take that long.
I think the biggest thing is the IT piece. They have a system that is really important because they operate off of this point-to-point system. Yeah. So these airplanes could be anywhere. That's why they call it the Greyhound of the sky. And if you're going to have planes all over the place, I think
it's been years. It's been a couple decades since I've been on a Greyhound, but I'm not sure that's a compliment.
I feel like it's a sign of, you know, how nimble
accessibility.
They are. Yeah. The accessibility, right?
Okay.
Right? Okay, sure. So that allows them to keep their balance sheet really tight, but it also means that they've got to be on top of it with the tech.
One interesting thing, though, I mean, we talk about sort of what made Southwest what it is, right?
Yeah.
I mean, a somewhat quirky culture, the idea of not just low-cost fares, but just it made the whole process easier for a lot of folks, at least relative to the other airlines. Does that get lost in this?
It is a bit of a PR nightmare, obviously, for Southwest, and that's why there is going to be a lot of renewed pressure heading into the first quarter of 2023 to have really cheap airfares to rebuild some of that trust with customers.
Yeah, we talked about this yesterday. This has been so much a part of what the culture is, right, at Southwest. They do it differently, and as a result, you don't have to pay as much to fly with them. But this is one thing that if it happens once, but if it happens again, then it becomes much more problematic for the company in terms of branding, right, and loyalty by its customers.
And it's probably a little bit of a shock to the system, especially for Bob Jordan, because they had such a great Thanksgiving. They were doing a lot better than other airlines. So he was feeling great heading into Christmas, and then this winter storm just...
And this is no easy task. I mean, anyone who's had a chance, and I've been lucky enough to go to be in some of the control towers, and you see what it takes to kind of keep these planes moving, keep people moving.
I want to go to control towers.
Well, it is an extraordinary. I mean, this is like, it's literally like, mathematical jujitsu that these people have to do to keep everything going. But what I think is interesting about this is we saw some struggles in the past with United and Delta. This was years ago before they modernized their systems, where they kind of went through something similar. And I don't know if there was a lasting effect on that, actually, in terms of public perception. I mean, I know we all kind of have our own favorite airlines, and we like to dig at this one versus that one. But overall, those companies are doing just fine.
They are, and I mean, this week, if you look at this as an example, today, or yesterday, rather, on Wednesday, we saw less than 40 flight cancellations from Delta, JetBlue, United, Delta One, with only 15 cancellations, and over 2,500 cancellations from Southwest. Those numbers are that's such a stark difference between these airlines. Another thing that I should mention also, we talk about the tech side of Southwest needing to be upgraded, but one example I heard from a gate agent who was talking about this on TikTok this week. She said that they were communicating lost baggage via pen and paper back in 2017 all the way until now. So that's just one example of the
This is why you put an Apple tag inside your luggage, so you know where it is.
So you know where it's stuck, Carol? So you know where it's stuck.
So you can always find it. I do wonder what the longer term story is. I mean, as I said, I think if they mess up again, then it's a problem. But it's
what about
a wake-up
regulators? Call. Do regulators have?
Confused. Wait. So with the Apple tags, you have to be within a certain distance.
No, you don't. You don't have to be within a certain distance.
Stuck in San Diego,
you see it.
It turns it into Romaine. This was like a big Christmas present in 2021. I got to get you some AirTags. I got to get you some AirTags, my friend.
And into Apple AirTags.
The way that they work is they sort of use everybody with an iOS device as a beacon. So you are, unwittingly being used as a beacon for my AirTag that's in my bag on my keys right now.
Okay, so you would know that if your bag was still stuck in Texas.
Yeah, based on people who have iPhones around.
You would just know it's there. You can't actually
get it. You don't share your location with anyone, Romaine, on your phone?
With my family, yeah.
Yeah, it's like the same thing.
They know where I am.
Find my friends.
I live a wonderful life. I'm here 12 hours a day. It's not like
they know you're at 731 Lex,
Then I'm in a car and I'm on the way home.
What are you keeping on your radar when it comes to Southwest at this point?
I live a great life.
To me, the big question is going to be how they use that $2 billion investment.
Are we doing the cocktail thing today?
That's tomorrow.
Like a mixologist or something?
That's tomorrow, Romaine.
Yeah. Oh, that's tomorrow.
Yeah. We're doing marijuana
today. Someone help Romaine now?
We are. Yeah.
Okay, but speaking of cocktails, actually, they are offering a lot of drink vouchers. So that is one thing.
Southwest?
That they're offering.
Nice way to bring it back.
Thank you.
Well
so they're going to have upset passengers and now drunk passengers who are upset. Is that a good combination?
Well, I mean, if it makes them happy, that's all that Southwest probably cares about here. But we got to see how that investment works on the tech side.
You have to do it in moderation, though.
Yeah.
Right.
Are you doing dry January, Romaine?
No. Any other questions?
You know what, Madison, we're going to take you, away from all of this because it's a little rough. Madison Mills, and don't forget she's coming up at the top of the hour on Sound On, so she'll be talking maybe a little bit more about this and maybe in terms of the regulatory environment if regulators want to do something.
What are we doing?
We're going to talk about yachts because I feel like in 2022, if we talked about yachts, it was often about the Russian billionaires and the yachts being confiscated because of the Russian war in Ukraine. Flip side to that story is folks were doing a lot of buying when it came to the luxury yacht industries. And what?
That was an interesting segue.
What?
Okay. I'm sorry.
All right.
Proceed.
Planes, trains, and automobiles and yachts?
Proceed.
Is that better? All right. Sometimes you just got to go for it.
Yeah.
All right. So let's talk about yachts. Not only buying, but how about tapping into it when it comes to the sharing economy? We've got a voice on that. Jacqueline Baumgarten is the CEO and co-founder of Boatsetter, the boat rental company. Think Airbnb of yachting. They have more than 50,000 boats in over 700 locations worldwide. Jacqueline, nice to have you here with us. So tell us a little bit about what you guys do specifically and how it all works. and what it costs if I want to maybe rent a
If
yacht.
you have to ask, you can't afford it, Carol.
Yeah, okay.
Not true, not with BoatSetter. So what we do, we're the leading marketplace where people can go to have an incredible experience on the water with, as you mentioned, over 50,000 listings, 700 markets, any type of experience you want to have, whether you want to go fishing, sailing, sandbar hopping on a luxury yacht, or wake surfing, we can make it happen with a few clicks on your phone. And it's a simple process with affordable options ranging from a few $100s a day to tens of thousands a day, depending on what you'd like to do.
Yeah.
The other thing that's super unique is we are the first and only insured peer-to-peer boat rental platform, which means private owners can list their boats on BoatSetter, and it means you're going to have access to more beautiful, well-appointed boats than you'll find anywhere else.
Well, that's what I'm curious. I mean, whose boats are these? I mean, give us a sense here of the breakdown of what you have available. Who owns those?
So of those tens of thousands of boats, we have commercially operated boats, but what's super unique are the privately owned boats that boat owners can list on BoatSetter. We are the only insured and legally compliant peer-to-peer platform. So it's allowing, I don't know if you know this, but in the United States, there's 15.6 million registered recreational boats, and they get used 12 to 14 days a year.
Oh,
That's
they're
it.
just sitting there. I know that. I sat by a guy for years who owned a boat, and all he did was complain about owning a boat. And I said, well, why do you own a boat, dude? And he said, well I like going out. 12 to 14 days a year. So in all seriousness, though, with someone like that who maybe doesn't use his boat as much as he probably thought he was going to use it when he bought it, he has an opportunity to go on BoatSetter and say, okay, I want to lease this out for a day or for a weekend to whoever comes onto the app.
That's absolutely correct. Not only that, what we're seeing is a big shift with people who are using, we're entering a recessionary time. And so people are a lot more sensitive to spend offsetting the cost of these assets. But we're seeing a shift into people turning this into a business and revenue stream where, we have owners that are going out buying more boats. They're making $700,000 on the platform. And this year, what we've seen, interestingly enough, 70 of the owners who listed this year made 75% more revenue in their first year than owners who listed last year.
Yeah. Are the types of boats that are being rented here, are these boats that need a crew, or is basically the person renting them going to be the one basically driving this and dealing with
you get to where the captain's at.
So wait, as someone who actually owns a boat, like, you don't have to have a license to kind of go out there. You do if you are actually chartering people. But I am curious that how many of these boat owners, I mean, lots of accidents happen if it's not somebody who knows what they're doing. So I do wonder how often that happens, Jacqueline, that somebody gets a boat back and there's problems.
Well, to your first question, we focus on safety first and foremost. So the boats that go out, they can go out either with a U.S. Coast Guard licensed captain at the helm, and that is at the choice of the renter, so you don't have to have any prior experience to rent, or the owner can designate that the boat only goes out with a licensed captain and or crew, depending on the size of the boat. You asked about the variety of vessels, and that's the beauty of BoatSetter. We have everything. If you want to go take a small runabout on your own with a couple of friends and go fishing or the sandbar, you can do that all the way up to super yachts and mega yachts that are fully equipped with captain and crew.
I'm curious about the liability here, and because if you think about it from the perspective of, I mean, every time I get insurance, for like a car, they're always like, do you also have a boat? And there's a reason they ask that, because this stuff is expensive to insure. Talk about liability, and I'm not talking about it from the perspective of someone damaging the boat, but I'm talking about worse, if something bad happens out there.
It's a great, great question. And this is where BoatSetter is truly distinguished. So these owners have their own recreational insurance policies. Your recreational policy excludes coverage if you rent the boat and collect $1 in exchange. What we've done is we've partnered exclusively with Geico, and we have the only peer-to-peer insurance policy in the U.S. So when you list your boat on BoatSetter, it protects the boat owner, the captain, and the renter. Most commercial policies don't cover the renter. Not only that, we have the largest database of U.S. Coast Guard licensed captains, so you can pick and choose your captain, see their rating. We also are focused on safety and launched last year the largest free on-the-water boating safety course called BoatSetter Academy, where you can go out in major cities and learn the basics of how to dock and how to work on the water if you want to take a boat out yourself.
Jacqueline, what does it cost? Just give an idea. And I know you've got a range of boats, different sizes, makes and models. So give us an idea, if we wanted to go out, give us an idea of what it would cost.
On average, it's going to cost you $700 to $800 a day that you can split with your friends.
What's your take rate from that?
So it depends if it's a commercial boat versus peer-to-peer. So it ranges between 12 to 15%, depending on whether we are providing the insurance for GEICO through the platform or not.
All right, very interesting. Jacqueline Baumgarten, really appreciate you taking time for us. She's the CEO of BoatSetter, peer-to-peer network for renting boats. So think Uber, Airbnb for boats. I know, and I know, Carol, you're, yeah, I mean, I know you're a yacht owner here, but is this something that you ever consider renting out yours? No.
First of all, the season's really small here on the East Coast, and so like,
why do you have a boat?
Why do I have a boat?
Yeah,
she's a woman of the sea.
What is this, like a 97 foot?
Yeah,
what is it, like that? Yeah.
Yeah.
That's good.
Helicopter.
Yeah, helicopter.
No.
But in all seriousness, though, I mean, what made you buy? Because boats are always sort of like one of those things that I grew up on the water too. But everyone always said, "Don't buy a boat unless you want to be broke."
My husband was like, "I want to sail, or we're gonna do a boat. We're doing boating. What do you want to do, sail or motor?" And I was like, "Let's do sailing." Okay. And so we've been doing it since we got married.
Sailing versus like renting an RV or something?
No, do like a motorboat, like
motorboat,
like water skiing and things like that.
Oh, okay.
Yeah. No, it's really lovely.
It is
kind of a hole in the water that you throw money in.
All right, yeah, for sure. All right, a lot more coming up on the show here. Here in New York City, the first time you've been able to buy cannabis legally, at least for recreational purposes, going to go down to the Village, where our very own Matt Miller is on this ground with a very special assignment. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, to say we've been looking forward to this segment is putting it mildly. He gave us a heads up yesterday, about 24 hours ago, a little bit more. Our own Matt Miller, because he is in downtown New York. Why? Because New York has opened its first legal cannabis dispensary, opened just a short time ago in Manhattan's Greenwich Village. He is there, looking rather dapper in a cute little sweater.
What's this outfit?
It's run by Housing Works. Matt, first of all, tell us about Housing Works and what's going on.
Yeah, so Housing Works, you probably know, right, already. It's a charity that runs thrift shops and bookstores. They give all of their proceeds to help the homeless and to help people with HIV. But now they're in a new business, and that is selling weed. This is the first place in New York where you can legally buy weed for recreational use. And it is very crowded. It's very exciting. There's a line that wraps around blocks here on Broadway and Astor Place. So I think it's a pretty historic moment, and I just had to be here. Obviously, it's also a really fascinating business story. They're going to raise a ton of money here for charity, but also a ton of money for New York State. They hope to get $1.25 billion in tax revenue over the next 6 years.
Well, Matt, talk a little bit about that, the revenue side of this. A lot of expectations, not just, of course, for what we're seeing in New York City, but other cities and states have also gone down this path. And I am curious as to what the promise is for revenue, for those numbers. I mean, a lot of enthusiasm on day one. Is that enthusiasm going to be there 100 days from now?
Yeah, well, I think New York State is also doing it quite a bit differently than most other states in that they're keeping it local, right? A lot of the licenses have been given to nonprofits, 8 of the total of 36 right now. The other 28 licenses that were given out are to individuals who are incarcerated or who were negatively impacted by the war on drugs. And New York is also giving 40% of the proceeds in terms of tax revenue to schools, 40% to grants for other nonprofits, and about 20% to anti-addiction programs. But they're really keeping it local. They're keeping it grassroots in a way that a lot of the other states haven't. You don't see big corporations forcing their way in here. Nobody's paying for shelf space to sell their products. And all of these farms, remember, all the farms have to be New York-based farms because they can't import weed across state lines from California or Colorado. They're owned by minorities, they're owned by women, they're owned by people who are disproportionately affected by the war on drugs. So they're really trying to right what they see as some wrongs that have been done over the past decades.
Yeah, the state is pretty far behind when it comes to recreational legal cannabis. I mean, voters voted to approve it in Colorado, a decade ago at this point, Matt. So certainly the city and officials have had a lot to learn from when it comes to mistakes or good things that other states have done. I'm wondering about revenue here, taxing here. How does the taxation work? And talk to us about just Housing Works and how much money Housing Works expects to make. If you're talking about the line being out the door at this point, I mean, that's got to be a good sign for demand.
Yeah, I mean, so Housing Works has given us a really lowball number. They said they hope to raise $1 million in total revenue
today?
In a year. I think from the looks of this, yeah, exactly. They're going to do that in a couple of weeks for sure. I mean, there's another illegal dispensary called Empire Cannabis Club, and they reportedly make about $6 to $8 million a month. That's what I've heard from sources around here. They're going to be shut down. They're big competition, right? You've seen the weed trucks all over the city, especially in Midtown around the banks. Those are hopefully going to be shut down so these guys don't face as much competition, but there are other problems. They can't take credit cards because of the federal laws, you know? They can't, as I said, import weed from other places, and it's difficult for them to find storefronts. In fact, the Office of Cannabis Management has had to source 150 different storefronts around the state that they're going to be giving out to license holders so that they can actually open these businesses, and so that they can grow the businesses.
Well, and lots of competition, right? You can actually, you know, in New Jersey and in Connecticut. I am curious too, Matt. Just tell us about what's going on behind you. There's a ton of people. Tell me what you've been hearing since you got on site.
Well, there are a lot of people who are excited to legally buy weed because for years they've been doing it, you know, in the dark and being afraid of getting arrested. So that's one thing. But a lot of the people here are really from charity communities. There are a lot of board members here from Housing Works and from other charities that are deeply invested in this. What I'm mainly hearing, though, is that it's an historic moment and people wanted to be part of it. There were people outside that have been waiting here for 6 or 7 hours to get in. They knew that the sales would start at 4:20. The first guy to buy weed here, the first retail customer, was a guy called Ken, who was a farmer who drove in from outside of the city. And he was just happy to get a safe, regulated product. The lab testing is really in depth. So that's one of the problems as well as far as getting the supply. Supply chain is also questionable. Will they have enough to meet demand? That's one thing they're concerned about this weekend.
Well, that's what I'm interested in, Matt. And I've been in some of these dispensaries in other states where it is legal. And the selection, I guess, varies pretty significantly depending on where you go. What type of selection do they have?
Yeah, so you won't see, in other states, you'll see a lot of Stizzy products, you'll see a lot of Cresco stuff, you'll see a lot of Curaleaf products. These are the big, in part, publicly traded companies. You won't see that here. As I said, they're female-owned businesses, minority-owned businesses that are farming this stuff. They've only got about 6 brands here to start.
Locally owned, handcrafted marijuana. So what did you try today? What did you try? What did you sample? Tell us.
In a sense, yes. I haven't tried any of it. Thank you very much, Romaine.
Okay.
But what they have is gummies. 5 and 10 milligram gummies. They have flour as an actual bud. They have rolled joints.
Right.
They have cartridges, so vaporizing cartridges. And right now, they have a pretty small selection of the local stuff, but they expect to offer hundreds more products as they get rolling.
Well, Matt, is the infrastructure, the supply chain there for this store to support it? I know there's been some concerns like coming into this.
Yeah, I mean, they have started very early. As soon as they legalized weed in New York for recreational use, they started giving out licenses to farms. 261 farmers in New York have been growing and then testing. The lab testing is apparently a very difficult part of the process to get the products in here. Now, will there be enough? I don't know. It's the fish run right now. Every year Fish plays 4 days at Madison Square Garden, and I can see that a lot of Fish fans are here. And they need weed.
Well, I know. I'm wearing the same sweater as Matt today. We're going together.
Hey, Matt, you mentioned the gray market, this idea of these vans, and it's hard to explain to people who don't live in New York City, but there are these vans that essentially sell weed out in the open. They've been doing it for a couple years. There's certainly one on my commute home, and it's kind of wild to see because it was illegal for so long, but it's just happening out in the open. And what they do is they don't actually sell it, right? They accept donations. And I'm curious as to how this affects the gray market and how you think full widespread legalization here in the city and here in the state, what happens to the gray market, which has returned pretty substantial.
Yeah, I mean, it's a really tricky issue, right? I remember, when I was a kid, walking through Washington Square Park, all the illegal sales being done there. David Lee Roth, I remember, got arrested. He was fined for buying weed, so even Diamond Dave couldn't do it. But now it's everywhere, even Wall Street bankers. If you walk outside of UBS, you see these weed trucks sitting there. It's questionable how good their stuff is. They're all going to have to be shut down. But the problem is, the reason they legalized it, the reason they gave these people licenses is to try and reverse the damage done through the war on drugs, and they're going to have to do a little bit more of that damage when they shut down these other vendors.
Matt, UBS PR is calling right now.
Yeah. I'm curious, Matt, too, about usage. I mean, we talk a lot here about sales being legal and the idea that illegally you can consume this in your home or a private space. Of course, we know a lot of people. Are you sampling something right now? What's happening, Matt? What did you just take?
No, I'm talking with another customer who's also a Bloomberg television viewer.
Oh yeah.
He's just made a purchase.
Oh my God!
Well, why don't you tell us what you bought?
Well, I got some really good flowers for sour diesel. I'm really excited about this. I'm actually in the cannabis business. I have a brand called Be Noble, and I made a film called Grass is Greener, which tells the whole history of cannabis, its connection to music from jazz to hip hop, but also look at the crime. So on Netflix, Grass is Greener, and New York, we got it popping, baby. It's really going down.
Hey, Fab, congratulations on that. Well, don't talk to this square here. Come on. He doesn't have an earpiece. He can't hear me. Matt, I just want to say,
a lot of celebrities here.
Are there other celebrities like this? You're hiding all the celebrities. What else is going on there, man? Now I'm interested in this conversation. And where's your hat? You normally wear these great hats, and Fab 5 is showing you up here.
Right. I left my hat on the floor over here. I don't want to get in trouble, right? I still need to dress the part of a Bloomberg anchor. But yeah, no, there are a lot of people here from the local community, a lot of people here from the hip-hop community, and a lot of people here from the charity community, which, as you know, is so big in New York. It's not quite as big as the weed community, but it's getting there.
All right, Matt, we got to run. You certainly wrapped it up in a fun way. Matt, please do come home and don't buy too much. We're just going to put it there.